Introduction: A Social History of the Great Crash. The Wall Street crash of 1929 was the most climactic financial disaster in history. It still affects all our lives today. Periodically, when the market declines, the question is asked whether history will repeat itself. For a decade or more, those warning of a likely repetition have been ably led by Professor Kenneth Galbraith, whose own book on the economic background to the crash has become a standard work of reference. That other doyen of American economics, Professor Milton Friedman, sees monetarism as our financial salvation. Both agree the 1929 crash was a financial turning point. Prior to that, the business of money was held to be the prerogative of businessmen. The crash showed how widely that prerogative had been dispersed. The crash affected everyone. It was the precursor to the Depression. As such, it was not only a financial collapse, but a human family tragedy. In a way, it was worse than war. One of those heard explained, "In war, Dad goes off, a hero. But soon after the crash, Dad was always at home." Nagging doubts were raised. Wasn't he smart enough to get a job? Was he really trying to get work? Doubts about Dad as a person grew and remain to this day. How such a situation came to be, we have tried to explore and include. Our intention is to present for the first time a full social history of the crash and its global impact. While the boom was essentially American, the ramifications of the crash were worldwide. It is our contention that the story of the crash is best told through the lives of people among them, the people who sowed the financial whirlwind that would scatter not only them but untold others in penury. They were the victims of a financial pandemic, the like of which the world has never before or since seen. Previous works have tended to restrict themselves to the New York market and its immediate environs, an admirable enough decision, but one that inevitably reduced the horizon. Our journeying into the hinterlands far beyond Wall Street produced a wealth of information buried in arcane documentation, private reports, and the accounts of eyewitnesses hitherto unrecorded. While ours too is a financial story, it is also a social study of a unique period in history, peopled with characters rich in every sense of the word. This history features Jesse Livermore, arch-manipulator and nemesis of the great bull market, locked in financial combat with great bulls like John J. Raskob, Billy Durant, and Charles Mitchell. Against the background of their wheeler dealing, enough to keep most men fully occupied, Raskob was preparing his own monument, the Empire State Building. Durant was running a single-handed campaign to overthrow the policies of the Federal Reserve Board. Mitchell, chairman of America's biggest commercial bank, was like the Artful Dodger, creating a scheme to avoid paying income tax on his millions. There was A.P. Giannini, founder of the Bank of America, hurtling around California in a Rolls-Royce dressed up as a fire truck, planning his latest moves in another great conflict. This conflict was one with the most powerful private bank in the world, the House of Morgan. The narrative includes Joe Kennedy, founder of a dynasty and self-made millionaire, determined to revenge himself on Jack Morgan, whose virtually last public appearance is recorded as being with a midget in his lap. Henry Ford, avowed enemy of Wall Street, was unwittingly providing the fodder for Hitler's anti-Semitism. There was Clarence Hatry in London, whose ambition, some believe, contributed to the crash. And there was Mike Meehan, who put Wall Street afloat on the Atlantic. Talking to the sons and daughters of these men and studying their contemporary writings, including their diaries and office papers, revealed the unsuspected connections between them and the tangled web of high finance. Often publicly distanced from each other, they were in the end drawn together into Wall Street by the mesmeric effect of the market. Their decision-making touched not only almost everybody in America, but also countless millions around the world. Charles Mitchell's decision to float a new bond affected the lives of Brazilian peasants. A loan from Jack Morgan helped to prop up Mussolini. Nazism grew in part because of the decision of American financiers to support the ailing Weimar Republic for profit. We have tried to look at the effects on all strata. On the one hand, there was Winston Churchill, who lost money, and a member of J.P. Morgan and Company, whose wife dismisses the crash as no more than the rattle of teacups. On the other, there was a young flapper and a vivacious bootlegger, both in a sense in the market, who, like so many others, were scarred forever by men they never met and decisions over which they had no control. Few man-made events, short of the world wars, created so much pain and bitterness and the fear it could occur again. Perhaps the only real protection against that happening is to have an understanding not only of why it happened, but of what it was like to be there when it happened. It began so promisingly, the events leading up to the day the bubble burst. The Rampaging Bull, late 1928. One wang of William R. Crawford's hand-tooled gavel against the fluted gong would stop everything. Crawford, superintendent of the mechanical department of the New York Stock Exchange, was acutely aware of the power embodied in his gavel. His progress across the 16,000 square feet of recently felt-padded floor had all the quality of a ritual. He was once described as Mammon's Lord Chamberlain. The superintendent believed the moment he used his gavel, the business of America would be fixed and frozen until the following morning. As he made his measured way across the more than quarter-acre of sacrosanct floor, his experienced eyes could see that it had been another highly satisfactory day for the elite in the room. The 900 brokers. At Post 1, United Aircraft was up a few points, a sign of growing public enthusiasm for air travel. Chrysler and General Motors were trading strongly. Shares in the railroads, Pennsylvania, Rock Island, New York Central, New Haven, and Union Pacific were being bought and sold briskly, every sale marking a heady profit for some investor. The biggest crowd was gathered around Post 12, the radio post, where the whiz kid of Wall Street, Michael J. Meehan, presided over the wheeling and dealing in RCA shares. Crawford was fond of saying that anybody wishing to check the pulse or the mood of America need only walk among the 18 posts. Each, with its group of designated stocks, reflected the unprecedented boom sweeping the nation. He believed that seeing these posts would reassure anybody that the millennium's arrived. Stocks in Woolworth, Macy, Montgomery Ward, Safeway stores, and General Foods were up, reflecting mass marketing techniques. The names of some shares, like International Nickel, International Tel & Tel, International Match, and International Harvester, indicated America's belief in her global destiny. Crawford and many others were firmly convinced that the world outside their heavily draped sanctum depended for its prosperity on the financial juggling performed there. This Monday at 2:59 p.m., exactly on schedule, the superintendent reached a small rostrum. Flanking the annunciator board with the stars and stripes and the blue banner of New York State, he had supervised the installation of ingenious reflecting devices which threw the magnified quotations from the paper tape onto large screens visible to everyone. This was the latest in a long series of improvements that had made the New York Stock Exchange the most modern in the world. From time to time this past year, the tickers had given news of setbacks in the market, to be swiftly followed by an even greater upsurge in value, sometimes as a result of the pools, syndicates of powerful investors putting their huge financial resources behind a stock, spiraling it to new and dizzy heights. Day after day, a vast and growing public continued to register its faith that what goes up need not come down. Now, at precisely 3 p.m. this Monday, December 31st, 1928, William Crawford temporarily halted their progress down that road with a single strike of his gavel against the stock exchange gong. The trading floor, immediately filled with brokers moving purposefully toward the doors leading to the visitors' gallery. Throughout 1928, the market's double sensations, unprecedented volume and soaring prices, had been front-page news. RCA had gone from 85 to an incredible 420 during the year, soon to be due for a split-up. These surges often occurred because the titans of the market wished them to rise. Spectators in the gallery stared down, trying to spot men like Michael Meehan, whose dealings in RCA made men millions overnight, and Frank Bliss, known as the Silver Fox of Wall Street. There was curiosity about the infamous Jesse Livermore, the boy plunger, known for attacks that pushed prices down. Informed gossip ran rampant. People who a year ago did not know the difference between a bear and a bull now talked knowingly of selling short and analyzed the moves of market giants like Arthur W. Cutton, Charles Topping, and the Fisher brothers. The gallery was cleared before the gong to avoid attractive female investors waylaying traders, as a woman's magazine had reported that stockbrokers equaled movie stars in sex appeal. When 3 p.m. was announced, a 5-piece orchestra began to play in the gallery. Guides opened burlap bags of confetti, ticker tape, paper hats, and noisemakers. Waiters filed out of the Stock Exchange Luncheon Club, one of New York's most exclusive, carrying silver tureens of clam juice cocktail, the official aperitif for the traditional New Year's Eve party. The gathering included members, staff, wives, and mistresses. Notable absentees included John D. Rockefeller and Jack Morgan. Shop talk predominated, filled with stories of spectacular killings. An actor had made $40,000. A waiter from the luncheon club resigned $90,000 better off from tips, having successfully plunged into the market. A stenographer was $15,000 richer from General Motors stock and promptly reinvested the balance in Anaconda Copper. John J. Raskob's optimism had driven GM stock up 12 points. Arthur Cutton's takings were put at $100 million. A group of young traders stiffened their cocktails with potent homemade whiskey and listened eagerly to Michael J. Meehan. Meehan, who started selling theater tickets, was now a celebrated broker. He had transformed his firm and earned an estimated $25 million from RCA's rise. Meehan was now preparing for a fresh foray into conservative Anaconda Copper stock, planning a pool with funds exceeding $30 million from figures like Percy Rockefeller, the Fisher brothers, and John J. Raskob. On the floor, couples danced fortified by hip flasks, the fashionable answer to prohibition now in its 8th year. Edward Henry Harriman Simmons, president of the Exchange, and Richard Whitney, vice president, circulated among the guests. Whitney, known as the Morgan Broker due to his connections, was the only person on the floor not permitted to trade who was seen in conversation with Simmons. Whitney was unpopular among rank-and-file members who resented his arrogance. He was heavily in debt, having borrowed $590,000 that year and lost it on speculative personal investments. Yet, he was confident the overpowering influence of J.P. Morgan and Company would help him achieve his ultimate ambition, to take Simmons' place. By early evening, only a few stragglers remained. Some were planning a visit to Helen Morgan's Speakeasy, one of 32,000 similar establishments in the Prohibition Dry City. Both houses of Morgan, Jack's Bank and Helen's Speakeasy, flourished in part because it was the heyday of easy money. The financial pages were being prepared. Alexander Dana Noyes, the veteran financial editor of the New York Times, noted sales of 4,387,700 shares brought the 1928 total to a new record of 920,550,32 stocks traded. Noyes, although twice proven wrong, clung to his belief that the boom would end. He told his reporters, "Something has to give. It's like an earthquake. The further you are from the last one, the closer you are to the next." He believed a crash was coming that would flatten Wall Street. Superintendent Crawford finally locked his gavel away and walked out into the deserted Wall Street. The lights at 23 Wall, the House of Morgan, were ablaze. Crawford paused, sensing the awesome power around him. He noted the massive edifice of the National City Bank and the historic Trinity Church, which had grown rich from the market, making Wall Street a perfect example of how religion and big business could be compatible. The events leading up to the day the bubble burst had begun promisingly. A view from abroad, across the Atlantic, the people of Great Britain began the new year with the feeling that, whatever it brought, it could only be an improvement on the one just ended. The year 1928 had been disappointing, consistently featuring newspaper reports that the hoped-for recovery in trade had not happened, leaving the economy in a state of continuous stagnation. Even so, for Clarence Charles Hatry in London, 1929 had got off to a good start. The domestic scene was dominated by enough news to keep the press occupied, from police raids on the capital's nightclubs for out-of-hours drinking, a perceived moral sin, to the ongoing police persecution of homosexuals and the intense newspaper scrutiny of the arts. Adding to the daily distractions were cumulus clouds of rumor building up around Thomas Edward Lawrence, whom many regarded as Britain's quintessential hero of the desert. The socialist newspaper, the Daily Herald, had dubbed Lawrence the arch-spy of the world, suggesting his presence in Karachi, ostensibly translating Homer, masked a deeper plot to organize a right-wing revolution. Hatry, an astute judge of such matters, knew the rekindled interest in Lawrence alone could last for weeks, drawing attention away from the financial world. Hatry knew too well how savage the press could be, bearing the scars of past critical coverage. His specialty was stock speculation on a massive scale combined with a flair for promoting large company amalgamations, which he ambitiously labeled part of his grand strategy for the rationalization of industry. This path had seen him make and lose a number of fortunes, including the liquidation of his Commercial Corporation of London in 1923 and the collapse of British Glass in 1926. The latter episode quickly faded from public memory. due to a vastly more important national event, the General Strike of May 1926. That crisis saw the conservative government mobilize armored cars and thousands of armed troops to defeat organized labor, bringing Britain to the brink of revolution over 9 turbulent days. The recovery from this political trauma was slow, but since then, the charismatic financier Hatry had prospered. His Drapery and General Investment Trust merged into Debenhams, and his corporation and General Securities issued £37 million in municipal loans. But Hatry, now 39, was poised for a venture far grander than his previous endeavors. He planned to acquire the securities of the United Steel Companies for approximately £8 million, thereby controlling about 10% of Britain's iron and steel industry. His ultimate goal was to amalgamate this group with still other independent companies in a series of takeovers designed to rationalize and modernize the entire sector. Eventually, he would resell this bumper merger to the public, earning a handsome profit while performing a great service to the nation. Hatry's timing was considered impeccable. Despite the national recession affecting export industries like coal, textiles, and shipbuilding, he observed encouraging signs for the economy's future. 1929 promised new industrial consolidations, suburban growth, and an increased standard of living, especially for the employed classes. The Central Electricity Board was linking superstations to a national grid, dramatically increasing electricity consumption. The auto and aircraft industries were expanding, and a retailing revolution, driven by mass marketing techniques imported from the United States, was boosting demand for tin-plated consumer goods. All these factors suggested a resurgence in the steel industry. However, Hatry's plan contained a fatal flaw: a lack of ready money to meet his colossal needs. He would have to secure massive bridging finance. Meanwhile, raising money was relatively simple for Winston Churchill, who, as Chancellor of the Exchequer, was preparing his 5th budget ahead of the general election. Churchill had already restored the gold standard in 1925, believing it vital to restore old economic values to secure Britain's prosperity. If the Conservatives were defeated, Churchill planned a comprehensive tour of America to indulge his passion for travel and, more practically, to secure specialist advice on his own American investments and assess the spiraling Wall Street bull market that so troubled the Bank of England. Some 900 miles east, in Berlin, Louis Paul Lochner, the Associated Press correspondent, found his task of reporting Europe's enthusiastic reaction to the booming American stock market frustratingly difficult. Apart from Switzerland, most of Europe was either consumed by internal problems or concerned with its neighbors' maneuvers. Russia was focused on Stalin's purges, struggling barely to return to pre-revolution production levels. Spain suffered from political inertia, while Italy, under Mussolini, wrestled with industrial and agricultural recession and falling prices. The Milan Stock Exchange was sluggish, virtually ignoring American markets. France remained an economic fortress with a balanced budget, a trade surplus, full employment, and huge gold reserves, making it entirely indifferent to events in Wall Street. Germany presented a complex picture. Lochner noted the country's spectacular recovery from the hyperinflation of 1923, largely fueled by an unprecedented influx of foreign capital, primarily from the United States. This inflow allowed German corporations to build new facilities and pay higher wages, keeping unemployment low. Yet, the nation's foreign debt had swelled to $7 billion, much of it in short-term, high-interest American loans. Some foreign investors were even withdrawing funds from Wall Street to exploit the higher German interest rates. Amidst this economic vulnerability, Lochner was increasingly aware of a growing political threat: Adolf Hitler. In Berchtesgaden, deep in the Bavarian Alps, Hitler had been strengthening his party, which now numbered 100,000 members. Hitler's two primary convictions, the danger posed by Jews and Germany's need for increased living space, Lebensraum, were mutually reinforcing. Hitler's ally, Joseph Goebbels, had supplied him with evidence from America, particularly the anti-Semitic articles written by Henry Ford that linked the Jewish menace to the perceived evils of American capitalism. Thus, even as the global financial system was centered on New York, its cultural and political tentacles were reaching deep into Germany, feeding the nascent Nazi ideology. The dealer-wheelers. Standing in a works manager's office, Henry Ford, the unsuspecting recipient of Hitler's gratitude, looked down on a scene that provided him satisfaction. It afforded living proof that the automobile industry was thriving, that the newspapers were not exaggerating when they said there were more cars on the streets of New York than there were in the whole of Europe. Beyond the gates, guarded by his own private police force, thousands of men were corralled in an open parking lot. Ankle-deep in icy slush, they shuffled toward the entrance to the Rouge plant, the largest of the Ford Motor Company factories in Detroit. 400 men every day would be taken on to meet an unprecedented demand for his cars and trucks. Those fortunate enough to be hired at 62.5 cents an hour were among the highest-paid manual workers in the land. Ford's obsession with cleanliness meant 5,000 men were engaged continuously in keeping the plant spick and span. A cheerful man at Ford's elbow was Harry Herbert Bennett, head of personnel. In reality, he ran one of the largest private armies in the United States, some 3,000 hand-picked guards, capable of instilling fear in even the toughest of workers. His salary, paid out of Ford's own pocket, no hardship for a man whose personal income in 1928 had reached $136,000 a day, ensured that Bennett was answerable only to Ford. Henry Ford could view with satisfaction the columns of men in the car park. His instinctive flair for publicity had again worked, making him the most widely discussed man of his time. Ford's dream of creating a memorial to those he most admired in the evolution of America was soon to come true. Greenfield Village, a 200-acre industrial museum. Two enemies remained constant at the top of his hate list: Jews and Wall Street. His anti-Semitism had always been an extension of the other phobias that riddled him. He first publicly attacked Jews in 1916, accusing them of starting the Great War. In November 1920, Ford bought a local weekly, the Dearborn Independent, which gave him a platform to wage an unfettered, virulent attack against Jews and their front men, the greedy bankers of Wall Street. The Independent set out to disrupt the lives of 3.3 million Jews living in North America. The Jewish boycott that followed wreaked his profits, forcing Ford to agree to an out-of-court settlement in the Aaron Shapiro libel case, recant his anti-Semitism, and close the Independent. Privately, Ford's hatred for Jews now focused on Wall Street. At a mile a minute, the Wolverine roared toward Detroit. In a private suite aboard the Express, William Croppo Durant, the great promoter, maintained solitary isolation. He had made an offer in 1909 to buy out Ford for $8 million and amalgamate the company into General Motors, an audacity his bankers refused to back. Without Durant's efforts, there would have been no General Motors, no mass-selling Chevrolet, no Buick, Oldsmobile, Pontiac, or Cadillac. The crucible for his dreams had been between 1910 and 1915. When Durant ran short of $10 million, the bankers pried GM from his grasp. Durant quietly bought up the company's voting certificates on the open market using profits from the Chevrolet Car Company, which he had founded after being removed from control of General Motors. He acquired enough GM stock to take control again. Then, in 1920, Durant found himself once more in financial trouble. He tried to support GM stock by engaging in personal market operations, but GM stock continued to plunge. At $12.14 a share, he became a ruined man, owing $20 million. He resigned on November 30, 1920. The only possession Durant took with him from General Motors was his portable barber's chair. Durant plunged into the stock market and found it was his natural métier. He made $1 million in a month, 50 in 3. Since 1924, Durant had headed a syndicate that had plunged up to $4 billion into selected stocks. Millions of Americans followed, pouring money into these shares, boosting the fortunes of the syndicate still further. Durant was preparing press releases attacking the Federal Reserve Board, sensing the board planned to reduce stock market speculation by raising interest rates and cutting off the flow of easy money with which the general public was increasingly playing the market. News that Billy Durant was heading for Flint reached Charles Stewart Mott via a secretary. General Motors' chief of advisory staff owed much to Durant, who had persuaded Mott to move his wheel and axle business to Flint, later bringing him into General Motors as a vice president. Mott maintained a carefully neutral position toward the existing GM factions, in his own phrase, in the good graces of the whole outfit. Under the guidance of Alfred Sloan and the ramrod straight Mott, General Motors was set for another year of success. The new General Motors team were engineering-minded and methodical. We leave all the glory of that kind of thing to such men as like to be labeled genius. A sly dig at Henry Ford. Mott's massive fortune was growing alongside the corporation's success, his salary boosted by profitable stock dividends. Yet the 53-year-old was hopelessly in love with the vivacious 29-year-old D. Van Balcom Fury. His romancing remained a closely kept secret in a city where the amours of motorcar magnates were of consuming interest. Should Mott ever quit the auto business, he could always go into banking. He had already laid the ground for such a possibility by becoming chairman of the board of the Union Industrial Bank in Flint. He rarely attended board meetings, confident that, after all, bankers are the last persons you need to keep an eye on. Peaks and Tremors, February 1929. Claire Giannini, looking out of the third-floor window in the Bank of America building, thought how short was Wall Street, a mere 6 blocks running down to the river. To her right, where Wall began at Broadway, the 20-story-high spire of Trinity Church was lost against the leaden early February sky. She knew her father, A.P. Giannini, had returned to New York determined to settle matters once and for all with the Federal Reserve Board, the Federal Reserve Bank of New York, and with J.P. Morgan and Company, who acted as advisors to the Giannini empire. The issue boiled down to the Federal Reserve Board and the Federal Reserve Bank of New York opposing the quotation of Transamerica stock on the New York Exchange. J.P. Morgan supported them. Their reasons amounted to a charge of impropriety in the way Bank of America stock had been transferred to Transamerica during Giannini's consolidation moves. At the confrontation, Morgan sent Frank Bartow as an emissary. Bartow insisted that the Fed was right and that there had been a violation. Giannini erupted. Nostrils flared, jaw thrust pugnaciously toward Bartow. The banker roared, "I will fight this to the last ditch." "We are absolutely right. We have been treated badly, badly." When Giannini insisted Morgan should support them, Bartow delivered a stinging ultimatum. "Right or wrong, we are for the Federal Reserve Bank. You can either do what the federal people ask or take your account away from J.P. Morgan and Company." Giannini thundered, "Then it will be a new experience for them." He dictated a letter of 2 short sentences, withdrawing all Giannini accounts from Morgan. He then sent a blunt warning to Gates McGarrah, chairman of the Federal Reserve Bank in New York, stating Giannini intended to resist to the bitter end any attempt to impair his lawful right to operate unmolested in the 2nd Federal Reserve District. Claire, reviewing the situation, noted that Wall Street was a maze of concrete canyons, walled by towering office blocks, reflecting the rapid economic expansion of the era. Where the volume of shares traded had grown to over 900 million in 1928, Joseph Kennedy, self-made millionaire and founder of a dynasty, had decided, against prevailing advice, to liquidate his stock holdings and gradually exit the market. His instincts sensed trouble, and his professional judgment urged him to bet against the crowd. Before quitting, he wished to speak with the one man in Wall Street who still overawed him, Jack Morgan. Kennedy arrived at 23 Wall, unannounced and uninvited. Convinced his reputation would grant him access, he asked the doorman to tell Morgan, "It's Joe Kennedy, back from Hollywood." The doorman relayed the message to Jack Morgan, seated at his roll-top desk in the partner's enclosure. Without raising his head, Morgan quietly murmured his response. The message was relayed back to Kennedy. "Mr. Morgan's too busy to see you." Without a word, Joe Kennedy walked out of the house of Morgan, determined never to forget or forgive the public slighting he had received. News of Kennedy's discomfiture reached Jesse Livermore, the arch-manipulator who operated from his secret suite in the Heckscher Building on Fifth Avenue. Livermore, although a frequent bear, was meticulous in his analysis, recording market movements in detailed notebooks. He saw the market growing perilously strong. On February 2nd, the Federal Reserve Board had sent a confidential letter to its reserve banks, asking them to refuse loans for financing speculation. Then on February 7th, the board issued a public statement warning of the excessive amount of the country's credit absorbed in speculative loans. Livermore correctly guessed that these well-meant words would have little effect on the general public. He saw it as a sign that the Fed was relying solely on persuasion to curb the rising call money rates. Livermore knew the Federal Reserve Board in Washington and its New York Bank were internally conflicting. The New York Fed wanted to raise the rediscount rate sharply, but the board, partly influenced by the Bank of England's Governor Montague Norman, resisted, fearing further capital drain from Europe. Livermore, analyzing external signals, noted the continuous influx of foreign funds. Gold imports exceeded $48 million, coming mostly from Canada and England, further destabilizing the world economy. Despite brief dips, stocks were rapidly advancing, with the averages rising 17 points in January. Livermore realized the severe dilemma facing the federal authorities. Raising interest rates would cripple legitimate industry and force the government to pay more on its own borrowings, while potentially having disastrous global repercussions. Yet if rates were not raised, rampant speculation would continue unchecked. Livermore's intuition, developed over years of successfully predicting financial collapses like the 1907 panic, told him that the high-flying market was vulnerable. He saw the relentless buying frenzy, coupled with the Fed's weak attempts at control, as a prelude to disaster. He recognized that the situation was building toward an inevitable climax. Livermore began meticulous planning for his next move. He would once again position himself to profit when the bubble burst. He calculated that a financial shock was coming, likely within a month or two. Buy until it hurts. The prospect of a crash was beginning to haunt architect William Lamb. In his nightmare, it flattened a square mile of Manhattan and left up to 1 million people dead or injured, buried beneath tens of thousands of tons of steel, concrete, and limestone, or shredded by the glass fallout from thousands of windows, all because he had miscalculated the structural strains involved in erecting the world's tallest building. The experienced Lamb knew he would never make such a mistake, but the fear persisted, a reminder of the awesome task he faced. Lamb knew better than to share his misgivings with John J. Raskob. The proposed Empire State Building was an obsession with the financier. The project also provided welcome relief from all Raskob's other involvements. Raskob told Lamb that this jingoism mirrored his own optimism in the economy. He saw the Empire State Building as a reflection of his faith in America's future. The financier would unveil still another plan to express that belief after they studied the initial plans for the tallest building in the world. Raskob saw that even in the crude drawings, the sheer elegance of the architect's concept was breathtaking. Lamb held up a pencil. "It'll look like this." Raskob looked at the pencil and nodded happily. Lamb's vision was a soaring, uncluttered structure, designed to overcome the rigid New York building code which limited the height-to-land ratio for skyscrapers. Raskob's advisors estimated the structural costs would come to $60 million. Borrowing the money was no problem. The critical question was how much would be paid in interest on such a huge sum. To keep that to the minimum, Raskob's accountants informed him the entire project should be completed 18 months from the day wrecking crews moved in to tear down the Waldorf Astoria. The 2-acre site was Raskob's, bought for $16 million. Raskob vowed the building would be their legacy, and for all who follow. Then Raskob unveiled his other plan. It was a way of life to embrace the whole nation. He was going to launch an investment trust, specifically designed to allow the poor man to increase his capital, just as the rich man is doing. His concept was one in which public ownership of our large industries becomes a reality. To help them, he planned to put $5 million into an equity security company, the purpose of which would be to buy stocks for proletarians who could invest $200 a head. The company would then buy a stock in $500 blocks. The $300 deficiency would be loaned to investors by a financial subsidiary. The $300 debt would be paid off at $25 a month. The money coming from what Raskob believed would be the assuredly increased value of the stock. Evangeline Adams was a regular traveler to Utopia. She had only to look into her crystal ball or shuffle her tarot cards. She was America's most famous fortune teller. Since 1927, coinciding with an upsurge in the market, Evangeline had concentrated on predicting its future. It had made her even richer, even more sought after. 4,000 people a day wrote to her. At $20 a reading, she claimed to predict how the Dow Jones Index and the New York Times Industrial Averages would behave. Her clients numbered some of the most famous in the land. Movie queen Mary Pickford always consulted Evangeline before investing. Morgan the Elder was said to have sworn by her prophecies. A lovingly retold legend claimed the financier once loaned $100 million simply because Evangeline said his rising sign, Aries, was favorably positioned. Morgan was rumored to have made a handsome profit from the loan. Evangeline's own horoscope had told her to come to New York on a certain day in March 1899. That evening she warned the owner of the Windsor Hotel that he was under one of the worst possible combinations of planet conditions, terrifying in their unfriendliness. The next day the hotel burned to the ground. Leland's family perished in the fire. On this February day, she was content to inform clients that call money would soon climb and that a violent upswing was indicated around the end of the month. The message from the medium was clear: invest now. Nowhere was this exhortation being so enthusiastically followed than in a private suite of the condemned Waldorf Astoria Hotel. Only women were allowed inside the suite, which was permanently rented by a stock exchange firm and decked out as a club. The suite was one of the dozens of specialty shops in New York catering exclusively for women investors. There were an estimated 5,000 more in other cities throughout America. Women's enthusiasm for investing was a spin-off from the fact that a large percentage of the depositors in U.S. savings banks were female and the growth of joint bank accounts. The banking house of Lawrence Stern & Company had concluded that women possessed 41% of the total wealth of the nation. This was evident in corporate shareholdings. United Steel Corporation had 59,688 woman stockholders. American Telephone and Telegraph Company had 250,000 women holding 55% of the company's shares. Eunice Fuller Barnard, a writer on the North American Review, visited the Waldorf Astoria suite. She noted the atmosphere was filled with aggressive guttural dowagers, gum-chewing blondes, shrinking spinsters, all watching the ticker tape. She collected picturesque examples of feminine luck. A scrubwoman made $15,000 on the market. A stenographer was $15,000 richer through selling General Motors stock she had only had for 2 days. Bankers and brokers told Barnard that women made better investors than men because, in the words of one banker, they had more common sense. Although there was no formal ban, the floor of the exchange was better protected against women members than that of Congress. No woman could buy a seat unless she received enough votes from the membership committee. The committee had never yet seen fit to favor the admission of a woman. Barnard concluded that lady investors would probably do more to raise the level of the common respect for women as a class than all the hard-fought suffrage campaigns, advertising, played a critical role in encouraging mass speculation. The New York Times, in common with the rest of the media, accepted advertisements that would never have passed the scrutiny of its publisher, Adolph S. Ochs. Many of the dubious advertisements urged readers to invest in bonds and stocks. The campaign encouraged Americans to purchase cars, radios, iceboxes, and even modish pastel-hued toilets. For those who could not afford to pay at once, credit facilities were available. One patriotic message urged readers that by buying fancier and more expensive rings, they were giving employment to more American craftsmen. Even the Greeting Card Association of America played its part, creating new holidays like Mother's Day, which boosted sales for candy manufacturers and telegraph companies. The funeral industry also joined the clamor. A New York casket and vault manufacturer advertised the Clark Graves Vault to defeat nature's destructive forces. Prospective clients were encouraged to buy sepulchres resembling Greek-pillared mausoleums, equipped with sealed boxes in which the departed's stock certificates might be placed. Big business took on human characteristics, friendliness, tolerance, and sympathy, all to attract more investors. Corruption spread widely among journalists. Richard Edmondson of the Wall Street Journal, William Gomber of Financial America, Charles Murphy of the New York Evening Mail, J.F. Lowther of the New York Herald Tribune, William White of the New York Evening Post, and W.F. Walmsley of the New York Times all received checks from publicist Newton Plummer for writing favorable comments about questionable companies. A radio commentator, William J. McMahon, received a secret stipend of $250 a week from stock manipulator David M. Lyon for praising shares. The few voices that protested were ignored. Veteran financial editor Alexander Dana Noyes grimly held to his position. A crash was coming. Bankers of a kind and vows Billy Durant was angry. The telephone connection with New York kept fading. Charles Edwin Mitchell, president of the National City Bank, repeated that the Federal Reserve Board's action to curb brokers' loans was already having an effect. Call money had jumped 3.5% in 48 hours. Now, on February 16th, it stood at 10%, and there had been a break of 21 points in certain stocks. Mitchell paused between each sentence of bad news. He reminded Durant of an attorney bullying a witness with inessentials before slipping in a loaded question. Mitchell framed his adroitly. Who would tell the incoming President of the United States, Herbert Hoover, that the financial health of the nation was based on credit, and that the Fed's killing the goose which laid the golden egg? Mitchell knew that Durant had already given several widely quoted interviews saying precisely that. He was also aware that Durant had easy access to Hoover. Durant promised Mitchell he would consider the best approach to Hoover. From his second-floor office, one of the largest and plushest in Wall Street, Mitchell had mobilized other forces to his bidding. Telephone calls had alerted obliging editors to start a campaign against the Reserve Board. Mitchell also spoke to Secretary of the Treasury Andrew Mellon, an old friend who was largely responsible for the benevolent attitude Washington displayed toward commerce and industry. Mellon promised to pass the word along that this was not the time to halt the full flow of America's industry. Commercial banks borrowed money from the Federal Reserve banks at one rate, then reloaned it to customers in the call money market at a higher rate. The present call money rates averaging around 8% meant that National City, borrowing at the fixed 5% from the Federal, made a handsome profit. Mitchell was dynamic, optimistic, and insolent, a financial emperor. In 1921, he had become president of both the bank and the National City Company, a wholly owned subsidiary of the bank whose main function was to deal in securities that the bank was forbidden by law to handle. He transformed the company into an organization with a staff of 1,400, 350 of which were salesmen. Driven ever on by Mitchell, his salesmen sold the American public $15 billion worth of securities in 9 years. They sold the stocks of automobile companies, which almost immediately went broke. The law forbade any bank to purchase its own stock. In 1928, Mitchell publicly withdrew his National City Bank from the market to prevent manipulation. Then just as publicly, he flouted it. Using his bank's affiliate, Mitchell began what he would later concede was an orgy of trading in his bank's stock. By January 1929, the price stood at $1,450 a share, having started at $785 in 1928. The company also acquired a $5,013,000 block of shares in the Boeing Airplane and Transport Corporation, later renamed United Aircraft and Transport. This stock was sold to the public at a profit of over $1,659,000. Mitchell and a group of favored insiders, including Percy Rockefeller, held 13,000 United shares, purchased privately from the company at $80 each. The issue of bonds for Minas Gerais, one of the states in the Republic of Brazil, was another major success. The bond issue, despite a confidential company report stating it would be hard to find anywhere a sadder confession of inefficiency and ineptitude, was marketed under a claim of prudent and careful administration. Durant decided to return to New York for consultation with Mitchell. He accepted liability for the collapse of Durant Motors, but revealed hopes to raise $10 million to reimburse stockholders. He continued to attack the Federal Reserve Board. Durant then set off for Flint, the town of his boyhood, to psychologically and physically recoup before returning to the fray of Wall Street. Meanwhile, in Flint, a monumental fraud was taking place inside the Union Industrial Bank. 15 men, including officers and tellers, were systematically stealing millions of dollars to play the stock market. Frank Montague, a vice president, viewed his complicity as merely borrowing money without approval to ease his family's financial strain. Milton Pollock, also a vice president, was stealing to cover the medical bills for his sick wife Elizabeth. Even Christensen, the assistant cashier, was the group's acknowledged leader, maintaining his expensive lifestyle and $75,000 mansion through speculation. Senior Vice President John DeCamp, stocky and seemingly solid, was drawn into the swindle by the irresistible pull of the market. Robert Brown, the president's son and a teller, was also involved. The conspirators employed two main schemes. First, the call money gambit. They took advantage of the daily flow of customer cash deposited for placement in the lucrative New York call money market. They recalled this money shortly after it reached New York but made no record of its return, recycling it for their own stock purchases. The second method was the fake note scheme, FNS, requiring careful forgery and teamwork. They diverted genuine share certificates passing through the bank, wrote out forged promissory notes in the names of prominent local figures like Charles Mott and William Crapo Durant, and used the notes to obtain loans for themselves. Over $2 million had already been stolen and invested in the market. In the midst of this desperation, Barbara Harvey, Jolyn Slezak's mother, decided on a plan. She insisted that her 15-year-old daughter must be married off as soon as possible. This action would allow Jolyn to claim the $400 trust fund her father had left in the Union Industrial Bank. The trust was accessible only upon Jolyn turning 18 or marrying, whichever came first. Barbara saw the money as an attractive dowry and a necessary boost to her family's precarious finances. Despite Jolyn's lack of interest in her pre-selected suitor Steve Vargo, Barbara was resolute. Love, she insisted, had nothing to do with it. The Pools and Marriages. March 1929. The sound of the first stirring bars of music rolled past the open suite door and down the corridor of New York's Ritz Hotel. A.P. Giannini, excited, played and sang Italian operatic arias. The breach with J.P. Morgan had left Giannini looking for talent that knew the ways of Wall Street, had the proper entree there, and a sympathetic understanding of nationwide banking. After 2 weeks of intensive searching, Giannini's interest had focused on the private banking and investment house of Blair & Company. Effective control of the firm was in the hands of Elisha Walker. Giannini had found Walker to be frank and open-minded, showing none of that cold aloofness which Giannini associated with men of Wall Street. Giannini had been characteristically forthright, telling Walker, "I need financial ability. Your company has it. I want your company." Walker traveled to Bermuda to discuss the matter with Blair and soon invited Giannini to dinner at the Blair Building. Giannini saw that his tastes had been catered for. His favorite Italian wine was offered, along with nuts and olives imported from Rome. He felt that anybody who could go to this trouble must be the sort of person he liked to do business with. Giannini was especially glad to meet Jean Monnet, a Frenchman who would be ideal to mastermind his plans to expand in Europe. Blair & Company would of itself provide impetus for Giannini's expansion plans, as its partners sat on the boards of nearly 200 American and foreign corporations. After dinner, Walker told the banker what he had been waiting to hear. Blair & Company was ready to be absorbed into the Giannini empire. Giannini now had an unchallengeable beachhead in Wall Street. By the late evening of February 28th, 38-year-old Michael Meehan, the stock exchange specialist in radio, had concluded he should launch another big pool in RCA stocks. Radio Corporation of America's shares had recently undergone a 5-for-1 split, and Meehan thought the price of around 70 was too low. He planned a short, sharp attack, lasting perhaps only a week, timing operations to start around March 12, the anniversary of the 1928 radio boom. Meehan engaged Tom Bragg and Ben Smith, two of Wall Street's most high-priced master manipulators, to manage the pool, supplemented by Bradford Ellsworth. A 3-page document marked Private and Confidential was circulated, setting out the terms. The syndicate would be limited to not more than 1 million shares, and the charge for operating the pool was to be 10% of the profits. 68 eager investors signed up. Among those who agreed to deposit $1 million was John J. Raskob. Walter Chrysler put up $500,000. Meehan's wife, Elizabeth, was on the books for $1 million. Billy Durant for $400,000. All told, the pool managers had $12,683,000 to play with. On Tuesday, March 12th, the day of the market opening, Meehan was outwardly calm, though nervous inside. The pool moved into action immediately, placing initial orders for 500 or 1,000 shares, quickly followed by a blockbuster order for 5,000 shares. News flashes hit the wire services that radio was on the move. By the noon close on Saturday, March 16th, radio had reached its peak, 109.1 to 4. On Monday, March 18th, the stock dropped back to 101, as the pool managers discreetly unloaded shares onto the unsuspecting public. The stock was eagerly snapped up. The pool was a huge success. The syndicate's net profit was $4,924,078.68. Raskob got his $1 million back, plus a check for $291,710.80. James Reardon received $58,342.15, having put up no cash himself. Billy Durant made $145,155.39. Mr. and Mrs. Meehan made $652,783.94, and their firm a further $580,000 in commission. While the market boomed, Charles Stewart Mott's marriage began to founder. Mott, General Motors' chief of advisory staff, planned a secret wedding for March 1, 1929, to Dee Van Balcom Fury. To avoid the press, newsmen in Detroit were told he was marrying in New York before honeymooning in Europe. The ceremony took place in Toledo, Ohio, witnessed by a handful of guests. But the marriage was troubled immediately. The chartered tri-motor aircraft carrying them to Mott's secluded Arizona ranch crash-landed near Anderson, Indiana, on the first day. Dee grew sullen, complaining about the accommodations and blaming Mott for the incident. After a week, D suggested divorce and asked for a property settlement and money. Mott soon concluded that D felt nothing for him personally and only wanted money. Meanwhile, Jesse Livermore's marriage experienced a temporary period of quiet. Since the market drop of late February and early March, a period where call money shot up from 6 to 12%, indicating the market was on the verge of breaking, Livermore had been focused on his personal life. Livermore and his wife Dorothy, who struggled with alcohol, had agreed to attempt a reconciliation. He was relieved to see his marital problems temporarily subside, allowing him to concentrate on the volatile market. Joe Kennedy maintained his position outside the speculative fray. The immense success of the Meehan pool and the aggressive optimism of his friends like Raskob and Cutton did not sway him. After the public slight at the House of Morgan, Kennedy had left Wall Street to enjoy time with his family in Florida. He followed the market keenly, noting the high rate of brokers' loans and the intense public speculation. Despite receiving enthusiastic encouragement from fellow operators and market tips from his shoeblack, Kennedy's cold professional judgment maintained his instinct. A market that everyone could play, and a shoeblack could predict was no market for him. He would wait. By the end of March, the public had absorbed the news of the market fluctuations, including the dramatic recovery spurred by the RCA pool profits, as just part of the excitement. The financial community was convinced the bull market would continue, driven by enthusiasm and organized support. Mott's marital troubles remained private, Livermore maintained his vigilance, and Kennedy held his ground, waiting for the instability to become undeniable. The corralled bull escapes. A. P. Giannini, traveling from New York to Oakland aboard the Overland Express, found himself in a state of high excitement mixed with concern. His recent success in absorbing Blair & Company secured him an unchallengeable beachhead in Wall Street. Yet the overall behavior of the market troubled him. He disliked the incessant newspaper stories claiming the secret to an everlasting bull market had been found. He worried about the tendency for tipsters and confidence men to become respectable, further indicating how far things were slipping. His fears proved prescient when, upon reaching Chicago late afternoon on Monday, March 25th, he learned call money had shot up to 14%, the highest since July 1920. Transamerica, like most stocks, had dropped in a market break which averaged 5 points. 90 stocks had plunged to their lowest point for the year. The ticker was running 50 minutes late. When reporters met him, Giannini expressed concern over what was happening in Wall Street. Meanwhile, Jesse Livermore, momentarily shaking off his marital problems, struck suddenly and unexpectedly at the market on Monday, March 25th. He sensed the market was on the verge of breaking due to the Federal Reserve Board's silence. He began to feed a bewildering stream of buy and sell orders into the market. He struck first at Post 6, catching American Can, American Woolen, and corn products before their prices began to tumble. He then switched his attention to Post 9, short-selling the rail stocks traded there. Avoiding AT&T, Livermore launched himself against Post 16, going short of Seaboard Oil just as it began to slip. The true gravity of the situation arrived the next morning, Tuesday, March 26th, when call money skyrocketed to a staggering 20%, the highest it had been for over 9 years. As if to mark the moment, a fuse blew on the new electric announcement board as the rate was posted. Prices fell almost vertically. Still, the Federal Reserve Board remained silent. Sell orders poured in at such a rate that by the close of the day, a new record was set. 8,246,740 shares had changed hands. Livermore, operating hidden in his Fifth Avenue office, bought at rock-bottom prices to cover the shares he had previously sold short. It was later calculated he made a profit of $200,000, or a little over $1,000 a minute for the 3 hours he had actually been actively engaged in the market. This serious break, which threatened to end the great bull market, galvanized Charles Mitchell, chairman of the National City Bank. Mitchell announced to the press, "We feel that we have an obligation which is paramount to any Federal Reserve warning or anything else, to avert any dangerous crisis in the money market." Mitchell spoke with the authority of his own mammoth bank and as a senior director of the Federal Reserve Bank of New York, signaling his intent to ignore the Federal Reserve Board's instructions regarding loans for speculation. The high call money rate was partly due to the board's efforts to restrict credit. Mitchell aimed to teach the board a lesson. Mitchell's bank was already heavily involved in activities bordering on illegality. In 1928, despite the law forbidding banks to purchase their own stock, Mitchell, through the National City Company, a subsidiary he also chaired, had engaged in an orgy of trading in his own bank's stock, boosting shares from $785 to almost $2,000 by March 1929. The National City Company also acquired major stakes in United Aircraft and Transport, making millions in profit by reselling to the public, while Mitchell and favored insiders like Percy Rockefeller bought shares privately at special prices. Furthermore, Mitchell was deeply invested in Anaconda Copper, through both the bank, as financier to the company, and the National City Company, as a principal investor in the Anaconda pool. The National City also financed 3 smaller pools in Anaconda subsidiaries: Andes Copper, Chile Copper, and Green Canania. Mitchell had accumulated 300,000 Anaconda shares planned for public sale. A falling market would jeopardize these efforts. With these weighty considerations in mind, Mitchell held his press conference on March 26th. His promise to loan money with no embarrassing questions asked immediately lifted the gloom in Wall Street. Call money began to drop, closing at 15%. Mitchell was hailed as the banker of bankers. Next morning, Wednesday, March 27th, Mitchell followed through on his promise by arranging for his National City Bank to borrow $25 million from the Federal Reserve Bank of New York, in open defiance of the Federal Reserve Board in Washington. The board, aware the money would be fed directly into the market, offered no public protest, signaling its weakness. Mitchell had won. The great bull market, breaking out of its temporary pen, resumed rampaging. Mitchell was cast in the media as the hero who had taken up Calvin Coolidge's mantle as patron of the boom. The total daily interest charge for funds borrowed specifically to play the New York stock market now ran at $280,000. Although thousands of small investors unable to meet margin demands were ruined during the fall, Mitchell's intervention immediately drew thousands more financial lemmings into the market to take their place, further deepening the market's underlying lack of stability. Billy Durant, seeing the market stabilize, decided his mission to Hoover had not been entirely in vain, but he needed to return to New York for consultation with Mitchell and others. He concluded that his next big market plunge should be planned for later in the year, convinced that the bull market would continue its climb. The corralled bull had escaped, running free across the economic landscape. Everybody's doing it. Until he discovered Pat Bologna's shoeshine stand at 60 Wall Street, Charlton McVeigh had a problem. Jack Morgan liked his keen young men to have gleaming shoes, a standard difficult to maintain after the subway journey from uptown Manhattan. For 10 cents a shine, 19-year-old Bologna not only restored them to mirror-like perfection, but also passed on a constant barrage of market tips and astonishingly well-informed gossip. Bologna was the self-appointed shoeblack to the titans of Wall Street. Joseph Kennedy, Charles Mitchell, and Billy Durant were among a long list of impressive names who used his services. He often shared his good fortune with his regular customers, and on this morning of April 9th he had a hot tip that Woolworth was going to double its capital. McVeigh took the information with a smile, musing that Bologna, with his quick, fertile mind, might learn enough inside the House of Morgan to set himself up for life, but knew no shoeblack would ever pass the doorman at number 23 Wall. Charlton arrived at 23, just as the first Morgan partners were turning in off Broadway. It was an unwritten rule that junior staff must always arrive before the partners, who, unlike most employees, were conveyed everywhere by chauffeured limousine. Charlton watched the imposing figures file in for their daily partnership conference around Thomas Lamont's desk, setting the guidelines for the firm's worldwide interests. McVeigh admired the calm, unhurried atmosphere of the huge central salon, feeling it was like being in church. The firm had recently promoted 2 large corporate ventures, United Corporation and the Allegheny Corporation, both designed to capitalize on the boom that had resumed following Charles Mitchell's open defiance of the Federal Reserve Board in March. Shares in the United Corporation had soared, having risen from $22.50 to $70 in 2 short months. United, a holding company, controlled a vast network of electric power companies, producing 20% of all the electricity used in America. This utility empire, whose assets totaled billions, was effectively controlled by J.P. Morgan and Company. Shares in Allegheny Corporation were offered to Jack Morgan's preferred list of 500 influential figures, including Richard Whitney, Charles Mitchell, and John J. Raskob, at a significant discount before being publicly listed. This concentration of power and wealth ensured the firm maintained its premier status. The prevailing market sentiment reflected total confidence, largely due to organized buying support led by key banking and corporate figures. John J. Raskob, the cherubic-faced financier, exemplified this bullish conviction. Having successfully encouraged investment through his article, "Everybody Ought to Be Rich," Raskob was relentless in promoting optimism. He argued that every banker had a solemn duty to encourage investment, maintaining that the market would climb for another 20 years and that many stocks would sell for 10 times their present price. Raskob's own faith was epitomized by his project to build the Empire State Building, a monument to America's economic future, which he continued to finance despite the increasing market volatility. This relentless optimism was shared by Billy Durant, who, having been assured by major corporate executives that their stock prices were not too high, planned to launch a new, massive consortium in late October to plunge billions more into the market. Durant believed that 10 or 20 of the leaders in the market need only maintain well-publicized, bullish positions for the public to continue. Buying this conviction in endless prosperity pulled countless small investors into the fold. The crowd flocking to Wall Street was composed of minnows, delivery boys, shoeblacks, cooks, and clerks, all investing their mites, often on margin, based on tips and rumors. By mid-August, the thronging streets had become a chaotic spectacle, a gold rush of feverish excitement. Homer Dowdy, a postman in Flint, observed the number of brokerage checks he delivered daily and envied those who grew rich, while wisely keeping his own savings in the bank. Pat Bologna, the shoeblack, saw the crowds as proof that the market was the place to be, believing his money never leaves the street. Charlton McVeigh, observing the frenetic activity as stocks continued their erratic upward climb throughout September, found himself growing uneasy. He was troubled by the public's constant and unhealthy preoccupation with money, and sensed many investors were driven by fantasy rather than reality. Yet even he struggled against the powerful psychological current. The belief system dominating Wall Street, that the market was invincible, protected by the wisdom of titans like Mitchell and Raskob, was so compelling that it overshadowed all cautionary voices, including the dire warnings of Alexander Noyes and Paul Warburg. McVeigh, soon to be immersed in the upper echelons of this financial world, was struck by the irrational yet irresistible optimism that had completely captured the American public mind. Wall Street afloat. The mass-produced alarm clock featuring a cathedral chime roused Edith Stone at midday. The strikingly beautiful 24-year-old divorcee, lounging in her New York apartment, felt amusement at being summoned by such an invention, which marked her as a social trendsetter. Although she possessed a keen, inquiring mind, she found her social life dominated by men who were utterly boring, capable of discussing nothing but their path to wealth through the stock market. Her father, Edward Stone, classified officially as a millionaire, had made his fortune vaguely from wool and the market, but Edith maintained a healthy disregard for money. She was striving to write a play about Wall Street, intending to give her script a blend of tragedy and comedy. She collected material, noting eccentric stories like the Boston Dowager who made huge profits by placing an order before the market opened and blindly canceling it after lunch, or the young man who turned $2,000 into $8,000 based on inside information. To capture the full scope of the financial phenomenon, she was preparing for a trip to Europe. Before leaving, Edith learned that in Paris, where she planned to visit, the bourse remained stubbornly traditional, listing almost no American stocks, protected by the national policy of gold hoarding led by President Raymond Poincaré. Edith's father had criticized this as an outrageously deflationist and selfish economic policy, a dangerous game that was leaving countries like Germany, Austria, and Italy financially defenseless. Her journey began aboard the Cunard liner Berengaria, leaving New York Harbor. The ship was carrying Mike Meehan's innovative floating brokerage office, which was running final tests to ensure stock quotations could be transmitted quickly across the Atlantic. Meehan, following a successful press conference on August 3rd, was confident in his new venture. He had secured the exclusive right to run the brokerage service on the Berengaria for a guaranteed $100,000 a year, quickly establishing a second office aboard the Leviathan to stay ahead of the French rival, Saint-Phal and Company, operating on the Ile-de-France. Meehan's service offered 2-minute execution time for orders, dealing in a select list of 100 stocks. Edith continued her research in Europe. In Berlin, she noted the growing menace of Adolf Hitler, observing uniformed Nazis who frequented the city. She visited the film set of The Blue Angel, starring Emil Jannings and the rising star Marlene Dietrich, and was shocked to see Jannings salute the Nazis. Later, visiting the Berliner Börse, she confronted her escort, a Nazi broker, and vowed to cut off his contact with her father. Sickened by the anti-Semitism, she cut short her trip, sending a terse telegram home before booking passage back to New York on the Berengaria, determined to inform her influential circle firsthand about the situation in Germany. Meanwhile, in Detroit, General Motors executive Charles Stewart Mott found his 153-day marriage to Dee Van Balcom Fury ending. Mott, who saw himself as a patient and tolerant husband, recorded Dee's coldness and her relentless pursuit of money. The final straw came when Mott discovered Dee had attempted to cheat him on a clinic bill by $1,000. Deciding to cut his losses, Mott instructed his attorney to prepare divorce papers for public release later in October. He temporarily left Detroit to visit Flint, intending to drop in unannounced on the Union Industrial Bank, where he was chairman of the board, purely for personal distraction. Mott's unexpected arrival at the bank on August 26th terrified the 15 members of the League of Gentlemen. Vice President Frank Montague was seized by fear that the massive fraud, involving the embezzlement of millions of dollars of bank funds used to speculate on the New York market, would be exposed. However, aided by the buoyant market throughout the summer, the embezzlers had been on a winning streak. They had been successfully diverting money by recalling funds clients intended for the call money market, using forged promissory notes in the names of prominent figures like Mott and Durant, and employing other illicit schemes. Their recent profits from auto and food stocks allowed them to recover close to half of the $2.5 million they had stolen. Christensen, the gang leader, maintained an air of supreme confidence, persuading the anxious group that they would soon be in the clear before anyone discovered the truth. Grant Brown, the bank president, inadvertently helped protect the secret by accepting Christensen's explanation that the cashier's expensive new house was financed by his wife's stock market winnings. Brown also approved Christensen's request to keep the bank ledgers close by, preventing him from discovering the intricate manipulations made by the embezzlers, thus ensuring the criminal operation continued smoothly, masked by the general exuberance of the national boom. The Hatry collapse and global rumors. Clarence Hatry was a shrewd, far-sighted financier whose specialty was stock speculation, on a massive scale combined with a flair for promoting large company amalgamations, which he liked to call part of his grand strategy for the rationalization of industry. His boldest scheme involved acquiring the securities of the United Steel Companies for around £8 million, intending to amalgamate this group with still other independent iron and steel companies in a series of takeovers that would rationalize and modernize the entire industry. Hatry hoped to resell the bumper merger to the public, earning a handsome profit while doing the country a great service. However, the political climate soon turned against him. Following the Labour victory in the British election at the end of May, Hatry sensed a bad omen. He felt strongly that this political upset could endanger his financial stability. Hatry's plan relied on securing substantial bridging finance, money needed to pay for the United Steel stock he was committed to purchase. The financier had already committed the bulk of his own ready cash and required further loans. He hurried to the City of London to seek assurance from Lord Bearsted, a director of one of London's most prestigious private banks, from whom Hatry expected a crucial £4 million in bridging finance. Hatry was stupefied when Bearsted denied any firm agreement. Hatry recalled reminding the banker of their plans, the conferences, and his expected share in the purchase price. Bearsted, however, insisted he was merely an interested spectator and had never agreed to back the venture financially. Stunned, Hatry left the bank feeling himself to be on the edge of some bottomless void that threatened to engulf his entire empire. The refusal forced him into a desperate decision. He must either renege on the deal with United Steel stockholders, risking total ruin, or raise the necessary money by some other means. His young managing director, Edmund Daniels, offered a ray of hope. By the law of averages, not all 40,000 shareholders would tender their shares immediately. The delay could buy them time to find the missing cash. For the next few weeks, Hatry and his associates worked round the clock, enduring intense strain and maintaining a bold front to prevent rumors of their overextended resources spreading throughout the delicate sounding board of the city. Money came in slowly, with shares occasionally being used as security for borrowing more cash to pay for further incoming shares. It was, Hatry said, like lifting oneself off the ground by pulling one's bootlaces. By late June, Hatry still needed a final fraction of money, £900,000. During a frantic late-night meeting at his mansion, his aide Gialdini, overwrought and threatening to shoot himself, pleaded with Hatry to agree to Daniel's desperate new plan. Against his better judgment, Hatry succumbed, setting in motion a gigantic fraud. The scheme involved the criminal practice of issuing scrip certificates for fictitious amounts far in excess of the stock they were meant to represent, and depositing this fraudulent scrip in banks as security for loans. This was done to raise the emergency funds needed to buy the outstanding United Steel shares. The fraud was intended to last only a few days until the deal could be completed and the loans repaid. But the constant need to support the falling shares of other Hatry companies forced the fraud to continue. By late July, Hatry was trapped in a pincer movement. The banks were likely to ask questions soon, and he still could not meet his full obligations to the United Steel stockholders. Hatry made one final attempt to save himself by asking Montague Norman, governor of the Bank of England, for assistance, but Norman adamantly refused, citing that Hatry had simply paid too much for his companies. The situation collapsed entirely on Thursday, September 19th, when the sheer speed of Hatry Company share price plunges, millions of pounds in 2 days, forced his hand. Hatry, along with Daniels and 2 other directors, presented themselves to Sir Gilbert Garnsey, a respected accountant hired by Lloyd's Bank. Hatry calmly confessed to fraud and forgery, admitting that his companies had liabilities of some £19 million against assets of only £4 million. He claimed the scheme had been executed out of loyalty to save innocent people and accepted full responsibility. Hatry requested Garnsey take him to the nearest police station. Instead, Garnsey went to Norman, arguing that a Hatry collapse would seriously affect the city and Wall Street. Norman, however, agreed only to suspend dealing in Hatry shares and insisted the men face justice. The following morning, Friday, September 20th, Hatry and his colleagues met Sir Archibald Bodkin, Britain's Director of Public Prosecutions. Hatry reiterated his admission of having raised money on fictitious scrip. Bodkin promptly summoned a Scotland Yard detective to take the confessions. Without incident, Hatry and his associates were taken into custody to await warrants for their arrest. The scandal exploded across Britain, dominating the front pages. News of the collapse spread immediately to the continent, causing market breaks in Paris and Berlin, and adding immense strain to the already shaky European financial system. The arrest of Clarence Hatry, the boy plunger of London, was the first major shock that preluded the greater financial disaster still weeks away across the Atlantic. Gathering clouds, July-September. Jesse Livermore, finding rare domestic calm, saw Wall Street in early July as a colossal suction pump draining global capital. Despite finding reports of American stock market popularity in Europe and Canada exaggerated, he noted the consistent flow of gold away from Britain and towards the United States. A.P. Giannini, back in California, was troubled by relentless speculation and felt the situation was chillingly reminiscent of 1928, when he had nearly been ruined. He was particularly concerned about the growing number of investment trusts, suspecting many were wildly speculative and poorly capitalized, designed primarily to fleece the unwary. Giannini feared these trends made the market vulnerable to a crash. His efforts to warn customers against margin buying were largely dismissed by the media, which craved only optimism. In mid-July, Livermore was plagued by lawsuits, including a $525,000 claim that he reneged on a stock peddling agreement. His personal analysis of the market showed disturbing internal weakness. Steel output and car production were down, savings were decreasing, and commodity prices were falling worldwide. Yet stock prices continued to advance, fueled by what he viewed as mass delusion, a children's crusade of amateurs. He concluded that the world economy was slipping out of alignment, suggesting that a financial trembler was imminent. He prepared his staff for battle stations, knowing that the minnows would panic when the inevitable shock came. Henry Ford, ever the master of publicity, continued to dominate headlines through August, capitalizing on his birthday and the dedication of his American village. He maintained his stance that he knew nothing of the stock market and hated the Wall Street gang of crooks. His income, estimated at over $136,000 a day, provided headlines that reinforced the national belief in endless American prosperity. In New York, the floating brokerage service on the Berengaria, launched by Mike Meehan, became a major news sensation, offering investors a safe way to play the market even while crossing the Atlantic. The market surged through early August despite high call money, validating the public belief that the millennium had arrived. The market's sudden high in early August was followed by a sharp break on August 12th. This volatility did not deter amateur investors. Instead, thousands flocked to Wall Street, drawn by the carnival atmosphere and determined to get a piece of the bull market. John J. Raskob, concerned by the panic, organized a luncheon for financial heavyweights, including Billy Durant and Arthur Cutten. Raskob urged them to use their influence to promote organized buying support, arguing that they had a solemn duty to ensure the boom continued. He reinforced his belief in the future by displaying the detailed model of the Empire State Building, declaring that a country which can provide the vision and the resources to build such an edifice surely cannot be allowed to crash. The high point of the bull market occurred on September 3rd, with the Dow Jones reaching 381.17. However, the next day, Livermore received secret intelligence from London that the American bubble has burst and that the Bank of England was considering raising its interest rate. On September 5th, economist Roger W. Babson, surprisingly given massive media coverage orchestrated indirectly by Livermore, predicted a 60 to 80-point crash. This triggered the sharp, but temporary, Babson break. Livermore used this volatility to short $300,000 worth of stock and cover quickly for a profit. The financial community breathed a sigh of relief when the market rebounded, but the international situation worsened dramatically. On September 20th, Clarence Hattrey, the British financier, was arrested for a monumental fraud involving over $1 million in fictitious scrip, having failed to secure bridge financing after Lord Bearsted reneged on a loan. The Hattrey failure caused markets in London and Europe to tremble. This pressure, combined with the continued drain of gold from Britain, forced the Bank of England to raise its discount rate to 6.5% on September 26th, surpassing New York's rate. This was intended to draw capital back to London. In the U.S., Richard Whitney announced that brokers' loans had reached $6.8 billion, a figure Raskob and Durant found deeply unsettling, suggesting weak hands were overcommitted. In Flint, the bank embezzlers lost $700,000 in 2 weeks due to the market's erratic behavior, but clung to the delusion that they could still stick tight and pray some more. By the end of September, despite 2 sharp declines, confidence was restored by the mantra of organized buying support. Through the first 3 weeks of October, confidence peaked. Call money fell to a 14-month low. Professor Irving Fisher declared, "I expect to see the stock market a good deal higher." On October 17th, Giannini, ignoring the general euphoria, launched his installment plan to encourage small, safe investing. But on Wednesday, October 23rd, with Exchange President Simmons conveniently absent on honeymoon and Acting President Whitney at the racetrack, the market suffered its most severe blow yet. Adams Express dropped a catastrophic $96 a share. Westinghouse $35 and trading hit 6.3 million shares. This was the final sharp decline before the abyss, the start of the bear attack. It fell on Livermore's desk sometime in the afternoon of Wednesday, September 4th. It came in the form of a message from London, whether it was by transatlantic telephone or by one of the coded telegrams that regularly arrived at his office, remained unknown. So did the name of his informant. Livermore took great pains to protect his sources. The message came in 3 separate parts. The first part said, "A high official in the Bank of England reportedly told associates over lunch in the city this very day, London was 5 hours ahead of New York, that the American bubble has burst." Several times in the past month, Livermore had heard similar assertions from sources in Europe. The second part quoted the same official as saying there were strong rumors Governor Montague Norman of the Bank of England was looking for an excuse to raise the interest rate before the end of the month. That was significant and made sense. The outflow of gold from Great Britain in July and August had been huge, the major portion of which was taken by France. The bullion stock of the bank was now a mere $137 million. There was an obvious need to re-establish faith in sterling. And as the Federal Reserve had raised the New York rediscount rate by 1%, there was reason to expect England to retaliate. If Norman did raise his discount rate, money earmarked for Wall Street would likely be diverted to London. That would be bad for the home market. The third part of the message was also thought-provoking. It stated that Clarence Hatry was in serious financial trouble. Livermore knew Hatry by reputation as an able and skilled financier. One thing puzzled him. If Hatry was endangered in London, why had he not turned to Wall Street for help? Livermore did not know the answer, but he decided to keep a careful eye on what sounded like a fast-developing situation. He turned to a report from another trusted source, one with access to the Federal Reserve Board. This Washington source did not expect the board to take any further definite steps in September. It had made its big move in August. The board would remain as sluggish as the Potomac, which it overlooked. It was a generally quiet day. The market closed with many prices having receded somewhat in what was described as an overdue technical correction. But General Motors, with a 3-point gain and RCA up a full 10 points, moved against the day's downward trend. Radio had increased $14 a share in 3 days of trading. Livermore, like many operators, wondered whether Mike Meehan was backing another pool. By early evening, he knew Meehan was as baffled as anybody why radio, which had shown little movement in weeks, had now sprung so dramatically back to life. The stock was one of the public's favorites. It seemed for no reason suddenly to have taken their fancy again. Livermore remained until midnight at his office, trying to piece together a jigsaw which did not have all the pieces. Next morning, Thursday, long before his weary staff returned to their calculations, he was back at his desk phoning, checking, cross-checking. He got people out of bed on the West Coast, out of meetings in London, Paris, and Berlin. Nothing really gelled. At 8 a.m., talking to a contact in Boston, he was reminded that today's luncheon speaker at the annual National Business Conference was economist Roger W. Babson, who had been bearish about the market for the past 2 years. Impulsively, Livermore asked his secretary to bring him Babson's file. Livermore had found Babson's public utterances had made no detectable impression on the market previously. Livermore looked again at the file on The Economist. This was the 3rd year running he had been invited to speak at the business conference. His previous speeches had not been widely reported. Livermore put aside the Babson file and called for others. He checked the Giannini folder. The latest entry showed that, on August 24th, the banker had issued a statement attacking margin buying. Livermore glanced at Paul Warburg's folder. Again, when the distinguished banker had spoken out earlier in the year about overvalued shares, the response was less than enthusiastic. He turned to the morning editions. It was a slack day for news. Livermore sensed the press would be looking for something different. On such a slow day for news, Babson, on previous record, could be just the person to give it to them. By mid-morning, every major New York and Boston newspaper, wire service desk, and the radio networks had received tip-off calls that Babson was to deliver a major financial speech at the conference. The tipster said the Times was sending Alexander Noyes to cover the occasion. Noyes was told rival financial editors were heading for the conference. Playing off one newspaper against the next was an old trick. Seldom had it been more effective. Soon Babson was receiving calls from reporters seeking an advance of his text. The Economist sensed that for reasons he could not fathom, the media this year were going to give him the full treatment. He told callers there would be no advance leaks. Press interest grew. Reporters knew a refusal to provide an advance generally meant a speaker had something important to say. In growing numbers, they headed for the conference. Professor Irving Fisher, of Yale University, one of the nation's leading economists, received a call from a Herald Tribune reporter in New York saying he might be needed to respond to Babson's speech. Fisher agreed to be ready to comment. By noon, Jesse Livermore had completed his plans. Using 30 brokers so as to maintain secrecy, he had gone short of some $300,000 worth of stock. He was about to execute his plan, driven by instinct and his carefully calculated manipulation of media interest in Babson's impending, doom-laden message. At 12:30 p.m., the Associated Press bells rang on their machines across America with a news flash: Economist predicts 60 to 80 points stock market crash. A minute later, United Press began to punch out the crucial words of Babson's speech. Sooner or later, a crash is coming which will take in the leading stocks and cause a decline of from 60 to 80 points in the Dow Jones barometer. It was enough. Nearly every afternoon, newspaper in America replated its front page to carry the sensational news. Radio programs interrupted their schedules to bring news of his forecast. The specialist financial wire services in Wall Street fed Babson's statement into brokerage houses. Around the country, the news flash went off like a bomb in W.E. Hutton. Within minutes, the telephones were ringing with investors wanting to sell. John J. Raskob and James Reardon agreed Babson's speech could do irreparable harm. Billy Durant rushed to the ticker. Westinghouse, Woolworth, Consolidated Gas, Adams Express, and Coca-Cola were all starting to slip. At Radio's Post 12, Mike Meehan watched sell orders coming at him from all sides. Livermore, meanwhile, continued to go short in his orders right up until the moment William Crawford banged his gavel. The market had been successfully attacked. Livermore was ready to profit. The bull breaks loose. Mitchell's intervention. The flow of European funds into the United States had reached full flood by mid-March. Despite Giannini's warnings about global economic tilt and Livermore's intuition of an imminent crash, the speculative frenzy continued, fueled by readily available credit. The struggle between the Federal Reserve Board in Washington and its New York Bank regarding control over speculative loans persisted, creating policy paralysis. By Monday, March 25th, the strain became too great. Call money skyrocketed to 14%, the highest since 1920. Transamerica, like most stocks, dropped in a break that averaged 5 points. 90 stocks plunged to their lowest point for the year. The ticker was running 50 minutes late. Jesse Livermore, momentarily free from domestic entanglements, used the chaos to strike. He had sensed the vacuum created by the Federal Reserve's inaction. At 10 a.m. on March 25th, he began feeding a bewildering stream of short-selling orders into the market through 30 brokers he utilized to maintain secrecy. He attacked specific stocks, striking first at Post 6, catching American Can, American Woolen, and corn products before their prices began to tumble. He then switched his attention to Post 9, short-selling the rail stocks. The big operators recognized his imprint immediately, but they were powerless to stop the wave of selling that poured in from around the country. On Tuesday, March 26th, the catastrophe peaked. Call money skyrocketed further, reaching a staggering 20%, the highest it had been in over 9 years. As if to mark the moment, a fuse blew on the exchange's announcement board, causing temporary laughter among the bulls. Prices fell almost vertically. Selling orders poured in so rapidly that trading volume hit a record 8,246,740 shares, the greatest in the exchange's history. Livermore, having judged the bottom, quickly bought shares to cover his short position, locking in a $200,000 profit, a rate of over $1,000 a minute for the critical 3 hours he was actively engaged. The severe break, which threatened to halt the great bull market entirely, was precisely the moment Charles Mitchell, president of the National City Bank, chose to make his move. His response was swift and publicly defiant of the regulatory authorities. He announced to the press, "We feel that we have an obligation which is paramount to any Federal Reserve warning, or anything else, to avert any dangerous crisis in the money market." Mitchell spoke not only with the authority of the largest bank in the country, but also as a director of the Federal Reserve Bank of New York, making his statement carry immense weight. He promised the public that his bank, irrespective of the Federal Reserve Board's policy of reducing credit for speculation, would make vast sums available for borrowers in the market. Mitchell's action was rooted in both self-interest and a genuine conviction that the government should not interfere with business. His commercial bank derived massive profits from the spread between the low rate at which it borrowed from the Federal Reserve and the high rates demanded in the call money market, which had reached 20%. Furthermore, Mitchell was deeply invested in ventures like the Anaconda Copper Pools and was managing stock accumulation for his National City Company, the bank's security affiliate. The market stabilization was crucial to ensure he could offload these positions at a profit and avoid institutional failure. The fall threatened vast holdings acquired by his company, including large blocks of United Aircraft stock and complicated bond issues like the Minas Gerais flotation, which was being sold based on Mitchell's personal assurance of sound administration. Mitchell's public intervention achieved immediate results. Once his promise to loan money was relayed throughout Wall Street, the gloom lifted. Call money began to drop, falling from 20% to 15% by the close of trading, and share prices rallied. By the next morning, Wednesday, March 27th, Mitchell had secured $25 million from the Federal Reserve Bank of New York in open defiance of the board in Washington. He had won the battle against the federal authorities. Mitchell was immediately hailed in editorials across the country as the savior of the boom. 3 senators demanded his resignation from the Reserve Bank, but the weak and vacillating Federal Reserve Board uttered no public protest about the way the single most powerful commercial banker in America had behaved. The great bull market, momentarily corralled, had escaped its pen and resumed its rampant course. The price of Anaconda copper stock was holding up well, and the thousands of small investors ruined during the break were swiftly replaced by thousands more financial lemmings rushing in to take advantage of the market's renewed vigor. Mitchell's decisive action had bought time, ensuring that the age of illusion continued. Concentrated power and public trust. Charlton McVeigh, arriving in Wall Street on Monday, September 23rd, was acutely aware of the palpable financial excitement, sensing the street had become a carnival of speculation. The crowds thronged the area, talking incessantly of luck and the breaks, their certainty in the rising market bolstered by the belief that organized buying support guaranteed continuous ascent. For McVeigh, the scene confirmed that Wall Street now served as a web which spreads over the whole country, its filaments finding their center in New York and running out in countless spokes, fastened upon every bank, every trust company, every great industry, every financial establishment. Inside the House of Morgan, the partners embodied the peak of American financial authority. With Jack Morgan vacationing in England, Thomas Lamont presided, maintaining strict order. Lamont and his colleagues, the ultimate decision-makers in a private bank impervious to government regulation, controlled an interconnected financial behemoth. Their influence extended to 10 major railroads, 13 public utility companies, 38 industrial corporations, and numerous insurance entities, representing total assets of $20 billion. This concentrated power was most vividly demonstrated by the swift creation of new entities designed to capitalize on the boom. The Morgan firm had recently pioneered 2 massive security promotions, United Corporation and the Allegheny Corporation. The United Corporation was essentially a shell-holding company designed to buy and control stock in other major companies, an empire that included 129 firms and supplied 20% of all the electricity used in America. This venture gave J.P. Morgan and company control over utility systems from Niagara to the sea. Shares in United Corporation had rocketed from $22.50 to $70 in mere months. The Allegheny Corporation, though yet to be formally organized, was trading briskly, having debuted at 35 a share. Its real value lay in who was invited to buy shares at a substantially lower price via Jack Morgan's secret preferred list. This list included influential figures such as former President Calvin Coolidge, the DuPont brothers John J. Raskob, and, crucially, Richard Whitney and Charles Mitchell. Raskob, for instance, had acquired 2,000 shares, writing to George Whitney that he deeply appreciated the many courtesies shown him by Morgan partners. This preferential treatment solidified the bank's influence across business and political spheres. Beneath this glittering facade of concentrated power and influence, personal financial vulnerabilities were rampant among the elite. Richard Whitney, the vice president of the stock exchange, was deeply mired in personal debt, owing vast sums to his brother George to cover catastrophic speculative losses in highly dubious ventures like a Florida fertilizer business. Whitney's own attempts to insinuate himself into major market pools, such as Meehan's radio pool, had been rebuffed, forcing him into riskier, isolated gambles. Simultaneously, top commercial bankers, including Charles Mitchell of National City Bank, William Potter of Guarantee Trust Company, and Seward Prosser of Bankers Trust Company, were all indebted to J.P. Morgan and Company through significant personal loans, placing them under the unspoken, formidable obligation of the House. This elite framework existed against a backdrop of public hysteria fueled by unchecked optimism. The public continued to heed calls like John J. Raskob's famous declaration that everybody ought to be rich. Raskob, addressing a meeting of financial leaders just days before the final crash, urged them to maintain a positive belief in the market and promote the message that many stocks would sell for 10 times their present price. He passionately argued that the nation's success, epitomized by his $60 million Empire State Building project, relied on this bullish confidence. The greatest public delusion centered on organized buying support. This phrase, which swept through the financial district, convinced the small investor that powerful banking interests would prevent any catastrophic collapse. When the market plunged on Thursday, October 24th, Richard Whitney, acting as Morgan's floor broker, dramatically confirmed this belief by publicly bidding record sums for key stocks, like U.S. Steel, stemming the rout and halving the day's $6 billion losses. The subsequent joint statement by financial leaders, orchestrated by Lamont, reassuring the public that the worst has passed, cemented the illusion that the market was safeguarded. However, experienced figures detected the weakening economic fundamentals. Industrial output and automobile production were declining. The $6.8 billion in brokers' loans represented a massive, unstable leveraging by small speculators, minnows easily overwhelmed by margin calls. Despite the rally, Lamont's confidential report to President Hoover acknowledged the need for caution, even as he argued against premature action that might throw a monkey wrench into the economic machinery. But the overwhelming force was the market's own momentum, driven by the belief that the boom would never end. As the market entered the final days of October, this shared delusion, bolstered by the visible actions of the banking elite, disguised the reality that the economy was fragile and overextended, standing poised on the brink of complete collapse. Wall Street afloat in Hatchery's collapse, the letter giving the New York exchanges formal permission for Michael Meehan to initiate his floating brokerage on the Berengaria had been handed to him personally on July 25th by Richard Whitney. 2 days before that, much to Meehan's annoyance, on leaving Le Havre, the liner Île-de-France had started its service for the French firm of Saint-Phal and Company. But the office on the Île-de-France ran into transmitting troubles and had to relay orders through London, causing a delay of 25 minutes before its trading transactions were confirmed. Meehan took comfort in the fact that orders from his shipboard office were sent by shortwave direct to the U.S. mainland. Investors on the Berengaria had their orders executed in just 5 minutes. Further, Meehan now had a second office afloat, aboard the Leviathan of the United States lines. On Saturday, August 3rd, radio and newspaper reporters began arriving at his office well before noon, the scheduled start for one of the largest press conferences Wall Street had known this year. Meehan was a popular figure with the press. At noon, accompanied by Arthur Costigan, the RCA expert who had supervised the radio test transmissions, Meehan walked into the room and opened the press conference. The brokerage service would handle 100 securities. 20 blue-chip and glamour stocks would be quoted every 15 minutes. 40 less active stocks every 30 minutes. The balance every hour. The minimum wireless charge would be $1 with no other extras beyond the normal commission. The journalist from the Wall Street Journal noted the 3-page document setting out the terms of the pool, stipulated all transactions would be in accordance with and subject to the rules and regulations of the New York Stock Exchange. Meehan had successfully established his operation. In Paris, Edith Stone had arrived for her European trip. She found the city gay, with an endless round of late lunches, elegant dinners, visits to the theater, and intimate suppers. She planned to visit the stock exchanges of Paris and Berlin to absorb local color for her proposed stage play. At La Bourse, the Paris Stock Exchange, she was impressed by the majesty of the building, which resembled an ancient Greek temple, but was disappointed by the lack of activity. Unlike New York, no American bonds or stocks were on offer. Her French uncle had warned her that the agents de change, like their New York counterparts, were renowned womanizers. She noted that the French were insular and arrogant, pursuing a gold-hoarding policy which her father had criticized as a dangerous game. In Berlin, Edith was struck by the ominous presence of Nazism. She saw uniformed Nazis roaming the streets and was frightened by their rabid anti-Semitism. She was sickened when her guide at the Berliner Börse, a stockbroker, revealed his Nazi allegiance and his anti-Jewish prejudice. Her father had warned her the financial hornlocking between France and Germany had the ingredients of high drama, but she was now too disturbed by the underlying menace to continue her research in Germany. She decided to cut her trip short and return home on the Berengaria. In London, on Friday, May 31st, Clarence Charles Hatchery visited Lord Bearsted. Hatchery, working 15 hours daily, 7 days a week, had been working on his plan to gain control of United Steel Companies Limited and needed roughly £8 million in bridging finance. He had approached Bairstead for £4 million. Hatry recounted the details of his merger plan and asked Bairstead if the recent Labour election victory would affect their agreement. Bairstead looked at Hatry steadily and replied, "What agreement? I have no agreement with you." Hatry was stupefied, insisting that they had reached a complete understanding. Bairstead remained firm. "I have never said that I would back it financially." "You must be mistaken." Hatry felt he was on the edge of some bottomless void that threatened to engulf his family, his homes, his racehorses, and luxury yacht. With no way to raise the funds from Wall Street or Europe, Hatry resorted to a gigantic fraud. On Sunday night, June 23rd, Hatry and his associates, Edmund Daniels and John Gialdini, met. Daniels proposed a scheme that meant borrowing money on the security of the corporation loans and repaying it inside a few days. Hatry was distraught and agreed against his better judgment. The criminal scheme involved issuing fictitious scrip certificates for amounts far in excess of the stock they were thought to represent, using them to secure loans from banks. The scheme went on for weeks. Gialdini, having stolen some $400,000, fled to Italy. By September 19th, the situation was untenable. Hatry's share prices had plummeted, and he could not meet his obligations to United Steel stockholders. Hatry and his remaining associates confessed their fraud to Sir Gilbert Garnsey, a respected accountant, admitting that scrip valued at $1.6 million had been falsely issued. Hatry insisted he undertook the scheme out of loyalty and accepted the entire blame. Garnsey visited Montague Norman, governor of the Bank of England, who refused to intervene. Hatry and his colleagues were advised to surrender to the law. On Friday, September 20th, Hatry was arrested and charged with conspiring to attain money under false pretenses. Trading in Hatry shares was immediately suspended in London, causing a financial panic in the city and sending ripple effects through European stock markets, which would soon be felt in New York. Rumors and global conspiracy theories. Wall Street had become, in Jesse Livermore's estimation, a colossal suction pump steadily draining the world of capital and creating a vacuum in Europe. This relentless transfer of wealth formed the backdrop for mounting global financial anxiety and domestic turmoil among key American figures. The international movement of funds had reached a full flood. Gold imports into the United States continued unabated, reinforced by funds flowing from a Britain made uneasy by its new Labour government and the need to defend the sagging pound. The bullion stock of the Bank of England fell far below the recommended minimum, leading eventually to Governor Montague Norman's decision on September 26th to raise the discount rate to 6.5% in an effort to reverse the tide. This action would soon be imitated by central banks across Scandinavia and Ireland, creating further instability. Meanwhile, France, strong and insular under President Aristide Briand, continued its policy of gold hoarding, drawing sharp criticism from Léon Blum, who thundered that Wall Street's call money needs were draining the world's floating balances and causing depression elsewhere. Edward Stone, Edith Stone's father, called the French policy a dangerous game that rendered Germany, Austria, and Italy defenseless. In Germany, where the economy was facing renewed inflationary threats and industrial disputes, the political climate was darkening. Edith Stone, visiting Berlin, was frightened by the growing presence of Adolf Hitler and his brown-shirted Nazis, whose rabid anti-Semitism was directed particularly toward the Jews of Wall Street. The financier Joseph Kennedy, proud of his Irish Catholic heritage, continued to monitor these global shifts closely, choosing to remain on the sidelines, skeptical of the market's long-term sustainability despite the overall bullish euphoria. The high-stakes world of New York finance was simultaneously characterized by both spectacular optimism and intense personal stress. Livermore, even as he monitored the market's vulnerability, remained preoccupied with personal and legal battles. He successfully settled the major Boca Raton lawsuit and managed the constant threat of being sued again, such as the claim from the Carbonite Corporation. More troublingly, the celebrated bear received frequent letters threatening his life if he continued to force prices down by short selling, prompting him to hire a full-time bodyguard. These pressures, combined with his unraveling marriage to Dorothy, who had returned to heavy drinking, drove Livermore into his office complex, where he dictated his investing guide. He emphasized the necessity of taking small losses and the folly of listening to outside advice, pointedly dismissing Professor Irving Fisher's optimism as based on information from a classroom rather than reality. Livermore's own gut reaction in September, fueled by the London news of Clarence Hatchery's collapse, led him to act, short-selling blue chips like U.S. Steel and General Electric just before price dips, earning him a cool $1 million profit by the end of September across the nation. Henry Ford used every available opportunity to maintain his image as the country's greatest living businessman and moral authority. His ongoing public relations blitz ranged from announcing the completion of his $20 million American Village, complete with a reenactment of Edison's light bulb invention, to sharing folksy anecdotes and promoting his eccentric diet theories. Ford's anti-Wall Street stance remained inflexible, but he briefly sought reconciliation with the Jewish community, linking the Old Testament figures of Moses and Aaron to the benefits of good diet. In Flint, Michigan, the League of Gentlemen inside the Union Industrial Bank experienced extreme market volatility that threatened to expose their extensive embezzlements. After early successful speculation in food and auto stocks, recouping significant sums of misappropriated call money, they were hit disastrously by the market breaks in September, losing nearly $700,000 in 2 weeks. This brought their total loss to roughly $2 million. The stress was unbearable for Frank Montague, while John DeCamp and Ivan Christensen frantically tried to sustain the fraud. When Grant Brown, the unsuspecting bank president, attempted to check the falsified ledgers for his new brochure, Christensen executed a desperate distraction tactic, demanding the books back under the pretense of checking margin calls, thus saving the conspiracy from immediate exposure. As October wore on, the financial district became a magnet for both the worried and the opportunistic. Giannini, increasingly alarmed by the overspeculation, publicly launched his new plan, encouraging small investors to acquire Transamerica shares through monthly installments, hoping to foster responsible investment. The warnings of financial authorities, including the Investment Bankers Association, who declared public service stocks had reached a danger point, were largely ignored by a public convinced that market leaders like Arthur Cutten and the powerful Morgan bankers would provide organized buying support. This delusion was shattered on October 23 and 24. Black Thursday brought panic, mass liquidation, and staggering losses. Though Thomas Lamont's swiftly executed banking pool temporarily stemmed the worst of the decline, the illusion was sustained for a brief reprieve. But as Monday, October 28, saw securities lose $14 billion in value, the eve of reality was over. Livermore, poised and prepared, waited for the decisive moment. He dictated the rule for all speculators to wait for prices to break through limits in either direction. That break came on the morning of Tuesday, October 29th, the day the bubble burst. Strategic moves and ignored warnings. Charlton McVeigh, hurrying as usual to be inside number 23 wall before the Morgan partners arrived, was one of the first to spot Joe Kennedy. The Irishman was standing in the shadow of Trinity Church as McVeigh strode into the street. He noticed that Kennedy looked fitter, leaner, deeply suntanned, and much more relaxed than the morning Charlton had witnessed his humiliation at the hands of Jack Morgan. These signs of a rejuvenated Kennedy confirmed the story Charlton had heard, that the Bostonian was nowadays leading a life of leisure. Kennedy, however, was not idling. He was working to a carefully predetermined plan. The murder of his father in May and his role as executor of the modest estate served as a reminder that he must secure his family dynasty through a truly vast fortune. Kennedy was monitoring the stock market with great care. For weeks he had been able to read and evaluate the trends well away from the influence of those most actively involved. He had come to the conclusion there was a danger that many of the people he could now see hurrying to work in Wall Street might be victims of their own propaganda, self-hypnotized spellbinders, unable any longer realistically to assess the market's probable future behavior. He came to the street to regain at first hand his own sense of feel, and to hear the views of the most intelligent, old pros. The soft-spoken, bespectacled Arthur Cutten, along with Raskob and James Riordan, were among those Kennedy met. Cutten, the commodity expert, insisted he was the most bullish in the bull market, reinforcing Raskob's own determined optimism that the boom would continue, a sentiment supported by Riordan's reports of booming bank business. Kennedy sensed, however, that for all their financial expertise, they were restricted by a narrow, localized Wall Street perspective. His inner nagging force urged him to stay out. His conviction was finalized after a quick consultation with shoe-black Pat Bologna, who, proud of his market acumen, offered a tip: buy oils and rails. They're going to hit the sky. Kennedy decided that a market everyone could play and a shoeshine boy predict was no market for Joe Kennedy. Meanwhile, abroad, Edith Stone had continued her journey, seeking inspiration for her planned Broadway play. In Paris, she found La Bourse, the stock exchange, majestic but quiet, lacking the frenzy of New York. French banking, she observed, was an economic fortress, committed to gold hoarding, leading financial writer André Costolani to liken France to an old miser. Edith's father had previously criticized this as a dangerous game, causing financial strain across Europe. Berlin provided far more dramatic material. Edith witnessed the rising menace of Adolf Hitler and his Nazi followers, brown-shirted, jack-booted troops roaming the streets. She saw the alarming casualness of their anti-Semitism. Her escort at the Berliner Börse, whom she initially disliked for his crude advances, revealed himself to be a Nazi, shocking Edith when he linked market weakness to Jewish traders. She fled the Börse, recognizing the profound shift in Germany. She decided to cut her trip short, returning to New York on the Berengaria, determined to write about the gathering storm in Europe, sensing a deeper purpose for her work beyond light comedy. Just as the clouds of war and financial disaster were gathering, Willy Messerschmitt, a stocky young German aviator, made a quiet, unheralded entrance into Wall Street in August. He came with high German references, ostensibly seeking capital to build passenger and freight planes. His true ambition, fueled by his admirer Adolf Hitler, was to raise funds that would ultimately be directed toward building a secret air force for Germany, an undertaking entirely contrary to the post-war treaties. This visit marked a further step in the unholy coupling of American capital and future European military expansion. Back in New York, the market continued its erratic dance. Following a dip after the Bank of England raised its discount rate, the market rallied. On Monday, September 30th, the public was reassured by the phrase "organized buying support," championed by figures like Arthur Cutten, who boldly stated he would not be disturbed if brokers' loans rose to $12 billion. This delusion of guaranteed rescue, coupled with the rising volume of stock purchased by small investors, the minnows, created the peak of illusion. But beneath the surface, the prudent were liquidating positions. Bernard Baruch, despite his friendship with Durant, sold out, and Joe Kennedy, still holding cash, waited. The forces supporting the boom seemed invincible, leading to the largest surge in new security issues that September. This peak of irrational confidence set the stage for the week of reckoning, beginning with the sudden dip on Wednesday, October 23rd, and accelerating into the catastrophic trading session the following day, Black Thursday. The peak of illusion, Raskob and the Titans. John J. Raskob had carefully chosen his guests for the unusual luncheon held in his suite in Carlton House. He had assembled them for a purpose far exceeding mere social gathering, intending to use the power and influence gathered at his table to shore up confidence in a stock market showing increasingly dangerous volatility. Among the 9 guests were some of the most influential figures in American finance and industry. Billy Durant, the mercurial creator of General Motors; Arthur Cutten, the nation's foremost commodity speculator and self-proclaimed bull; Percy Rockefeller, representing old money; the DuPont brothers, the reserved railroad titans Oris and Mantis Van Sweringen; James Reardon, Raskob's trusted friend; and William Lamb, the architect of Raskob's ultimate statement of optimism, the Empire State Building. The gathering was an unusual mix. The refined DuPonts and Rockefeller had little in common with the homespun Van Sweringens. Reardon was the only guest fully aware of Raskob's strategic agenda. Raskob, in his vivid shirt, radiating vitality and confidence, set the tone for a discussion that quickly bypassed small talk to focus on the future of the market. Durant, eating little and sipping mineral water, sat impassively, occasionally sniffing a cigar, a gesture that did not distract his host. Raskob spoke with a measured authority, foregoing his usual bombast to lend gravity to his words. He acknowledged that powerful factors were giving unfavorable attention to Wall Street, creating instability. He urged his peers to put aside their prejudices and maintain a positive belief in the market to meet these threats head-on. He praised Cutten's recent public bullishness and insisted that big investors had a solemn duty to promote the market vigorously in the media. He argued the market could climb for another 20 years, predicting that many stocks would sell for 10 times their present price, and brokers' loans, then peaking dangerously high, would eventually be billions more than they were now. Raskob addressed the recent market breaks with calculated dismissal. He reminded them that throughout September, the market had endured no fewer than 9 major declines where millions of shares of well-managed companies had been sold by investors fearful of being caught in a bear trap. He attributed this volatility partly to pernicious pessimist Babson and largely to short-sighted speculators who accepted small profits or reduced long-term holdings at the first sign of a rally, thereby preparing the ground for further declines. He insisted that the recent market behavior was driven by emotion, not fundamental economic reality. He drove home the point using a rumor concerning U.S. steel. When steel stock led a small rally after the recent tumble, it was rumored this was due to new orders from the railroad industry, or as Van Sweringen, whose company controlled billions in rail assets, immediately denied knowledge of any such orders. Raskob seized this denial as triumphantly confirming his thesis. The market rallied because it refused to be intimidated by outside forces, demonstrating its own powerful psychological momentum. Raskob's message was unequivocal. All investors, but especially the heavy hitters, must counter the rot of pessimism. For the masses who were still flocking into the market by the tens of thousands, Raskob believed the market must have the continuing, strong support of big investors. If they maintained their bullish positions, they would sustain the boom and protect the small investors who were essential to the market's volume. The climax of the luncheon arrived when Raskob rose and, with James Reardon, fetched a large-scale model of the Empire State Building, placing it carefully on a side table. He introduced the structure not merely as a business venture but as a monument to the future, symbolizing the America he believed in, a land which reached for the sky with its feet on the ground. Architect William Lamb detailed the staggering scale of the project, which needed 60,000 tons of steel, enough to lay a railway track from New York to Miami, 10 million bricks, and 1,000 miles of telephone cable. Lamb explained the ambitious construction schedule, noting that each girder would be riveted into the structure within 70 hours of being shaped at the Pittsburgh mills. He calculated that if all the material needed for the structure arrived in one shipment, it would require a train 57 miles long to carry it. Raskob finished by linking the monumental physical undertaking directly to their financial duty. He declared that a country which could provide the vision, the resources, the money, and the people to build such an edifice surely cannot be allowed to crash through lack of support from the likes of you and me. His passionate appeal secured the necessary verbal commitment from his guests to support the market, bolstering the shared illusion of endless prosperity, even as the final collapse approached. The Babson event and moral crisis. Jesse Livermore calculated it was mainly the minnows who had suffered so far. His staff had analyzed the trading pattern throughout the day. The greater proportion of shares had been sold in bundles of a few hundred. The big operators, those holding large blocks of stock in one issue, had, like Livermore, kept their nerve and maintained their margins. Livermore, in spite of his initial gut reaction, had done little more than support his position. He had neither lost nor made money yet. While the market maintained its uneasy equilibrium across the Atlantic, the moral rot underlying certain financial empires was exposed. Clarence Hatry, trapped by his overwhelming commitments to the United Steel acquisition, and Lord Bearstead's refusal to supply the crucial $4 million in bridging finance, had desperately resorted to criminal measures. Since late June, he and his associates, Edmund Daniels and John Gialdini, had perpetrated a fraud involving the issuance of fictitious scrip certificates. This action, intended as a temporary measure to secure funds for the steel deal, had spiraled out of control, prolonged by the need to support the falling market value of other Hatry companies. In mid-September, the crisis peaked for Hatry. Gialdini, under unbearable strain, had fled to Italy, absconding with hundreds of thousands of pounds. Hatry's last-ditch appeal to Montague Norman, governor of the Bank of England, was summarily rejected. Norman's refusal stemmed from his long-held disdain for Hatry's speculative methods and his concern that a bailout would only further unsettle the already jittery city following the Labour victory. The very next day, Thursday, September 19th, Hatry and his remaining associates met with Sir Gilbert Garnsey, the chartered accountant retained by Lloyd's Bank. Hatry, looking to assume full responsibility, calmly confessed to a colossal fraud. His empire, once valued at $20 million, had total liabilities of some $19 million and assets of only $4 million. Guernsey, appalled by the stupendous scale of the crime, informed the Director of Public Prosecutions, Sir Archibald Bodkin. Hatry and his colleagues were subsequently arrested, sending shockwaves across London's financial district and leading the London Stock Exchange to suspend trading in all Hatry-related shares. Back in New York, on the same day Hatry saw Guernsey, Livermore's instinct suggested that the collapse of the British financier could have a devastating ripple effect. His premonition was amplified by his staff's reports revealing that many listed American stocks were already selling at ridiculously high prices. The following day, Thursday, September 5th, marked the moment of sudden reckoning for many American investors. Earlier that morning, Livermore, acting on his deep-seated bearish instincts and noting that the media was primed for a headline, secretly tipped off major news outlets about the scheduled lunchtime speaker at the annual National Business Conference, economist Roger W. Babson. Babson was notorious for his pessimistic market outlook. The ploy worked perfectly. At 12:30 p.m., the news agencies flashed the warning. Economist predicts 60 to 80 point stock market crash. The market reacted immediately. Sell orders poured in, overwhelming the exchange. Prices fell almost vertically. Westinghouse, Woolworth, Consolidated Gas, and Coca-Cola all began to slip severely. Livermore, executing his well-timed plan, utilized 30 brokers to short-sell approximately $300,000 worth of stock. Betting ruthlessly on the ensuing panic, the emotional backlash was instant. John J. Raskob and James Riordan, playing cards in New York, rushed back to their offices, recognizing the irreparable harm Babson's widely publicized prophecy could inflict. Billy Durant, receiving the news via telephone, rushed to his ticker, while Mike Meehan watched the avalanche of sell orders bury Post 12. The market break, severe as it was, ultimately proved short-lived. Professor Irving Fisher swiftly issued a rebuttal, rejecting the possibility of a crash, and by the close of trading, Livermore, having covered his short position just in time, had cleared some $200,000. By Saturday, the optimism was restored, and Babson's prediction was dismissed as the ravings of a pessimist, although he was quickly hired by a New York tabloid to write a financial column. However, the moral and financial strains continued. The sudden volatility in the first half of September devastated the Union Industrial Bank's League of Gentlemen. They were caught wrong-footed by the Babson break and subsequent market swings. The embezzlers, including Frank Montague and Robert Brown, had wiped out their carefully accumulated gains from the summer and plunged nearly $700,000 deeper into debt. They were now compelled to steal further to cover their mounting deficit and meet their desperate margin calls. The international environment further destabilized Wall Street's confidence. Following the Hatry scandal, the Bank of England on Thursday, September 26th, advanced its discount rate to 6.12%, a clear attempt to staunch the gold hemorrhage to New York and Paris. This move, immediately imitated by several other European central banks, caused a fresh market decline that continued into the end of the month. On the final trading day of September, the market appeared steady, but appearances were deceptive. Charles Mitchell, determined to maintain confidence, announced he would borrow $10 million from J.P. Morgan to support his own stock, even as his personal affairs required him to execute a questionable tax law scheme involving the sale of bank stock to his wife. The month closed with the Dow Jones average up, but fundamental cracks remained. Brokers' loans were at a record $6.8 billion as industrial production was down, and an increasing proportion of shares was held by amateurs buying on dangerously thin margins. Wall Street was floating on a collective delusion, poised delicately above an abyss. The final acts: wedding and the broke executive. Gray top hat placed squarely on his head. Edward Henry Harriman Simmons stepped briskly out of his home at 8 on 12 Park Avenue on Friday, October 4th, the president of the New York Stock Exchange, in his usual dark suit and stiffly starched white shirt, looked unconcerned. Neighbors who had read the dire headlines in the New York Times announcing the year's worst break had to marvel at his sang-froid. In fact, Simmons was acting, determined that nothing, least of all the turmoil in the market, would disrupt his most carefully laid plans. He wanted no one who saw him coming out of his handsome townhouse to believe anything untoward was afoot. The same composed pose was adopted by his companion, Alan Lindley, as the two men settled in the back of Simmons's chauffeured limousine. They were heading to Park Avenue's Presbyterian Church, where, shortly afterward, Simmons would wed Beatrice Vanderpool Bogert before a handful of close friends and relatives. At the reception afterward, the bridegroom announced that they would leave the following day for an extended 2-month honeymoon in Honolulu. There was no mention of the stock market. Simmons was particularly pleased he had managed to avoid the press, fearing his departure during such instability would be misconstrued, particularly if his deputy, Richard Whitney, had leaked the news. Richard Whitney, however, was not at the wedding. While Simmons, on principle, disliked the media, Whitney possessed a great appetite for publicity, a trait Simmons found unbefitting an exchange officer. But Whitney was otherwise consumed. At 41, he was fulfilling a long-held dream to be the youngest man ever to sit in the president's office. Yet the crisis gripping the market offered a new peril. His tenure had begun even before Simmons's wedding. In May, Simmons had quietly informed Whitney he would be the sole candidate in the ballot for the next president. Whitney was not unduly alarmed by the market's fluctuations. He insisted the market was fundamentally sound, but he possessed a character flaw that was becoming increasingly dangerous. He was a master of self-delusion, believing only the information that supported his bullish outlook. This was exacerbated by his desperate need for the market to thrive. Having borrowed vast sums from his brother George, he had poured money into reckless, non-listed speculations like mineral colloids and peat humus companies, stocks generally avoided by even the wildest of brokers. He had been so unsuccessful that his personal financial situation was nearing catastrophe, putting him on a slippery slope similar to Clarence Hattrey's. Now, as acting president, Whitney found himself privy to confidential exchange reports and technical analyses intended to guide the exchange in listing policy and market integrity. This privileged information gave him new opportunities to profit, but the high-risk, low-grade stocks he continued to favor were plunging. His personal ruin loomed, and the one person who could save him, his brother George, was losing patience. Unwilling to confess and too arrogant to believe he could fail, Richard Whitney continued to leverage his powerful position to survive, remaining master of the exchange floor despite his inner turmoil, ready to take advantage of any situation that presented itself. While the titans of Wall Street braced themselves for the financial fallout, the small world of Flint, Michigan, prepared for a different kind of ceremony. On Friday, October 18th, Jolyn Sledsack and her brother, Michael, hurried to the Union Industrial Bank just before closing. They reeked of spirits, having spent the day pressing dough around the basement stills to minimize the giveaway fumes of the bootleg liquor being brewed for Jolyn's imminent wedding. Michael, having recently turned 18, wanted to withdraw the modest trust fund left by their deceased father. When he approached the teller, Russell Runyon, Michael learned that the money was tied up. Jolyn, however, saved the day by declaring she was getting married tomorrow, Saturday, October 19th. Runyon, astonished by the 16-year-old bride, confirmed that marriage would trigger the release of her funds. Jolyn, still smelling strongly of mash, asserted confidently that she would send Mr. Goldberger, the family attorney, if the money was not ready next week. The following morning, Saturday, October 19th, the market opened weakly. In New York, the 2 hours of trading would see stocks plunge as much as $40 a share. But in Flint, Jolyn's attention was elsewhere. The first flakes of snow fell as she slipped into her $100 wedding dress, paid for by her mother's bootlegging profits and new underwear, replacing the flour bag panties she had worn since childhood. She walked up the aisle on the arm of her stepfather, oblivious to the fact that her small sum of money, along with the savings of thousands of other Flint citizens, was still held captive in the Union Industrial Bank. The reception was held in the St. Joseph's Catholic Church basement, which had been transformed into a festive hall. Andrew Arvey and Steve Vargo poured the raw, home-brewed liquor, allotting a pint for every adult among the 300 guests. The local police, thanks to Mr. Boker, provided protection against prohibition agents. The Hungarian community's traditional wedding gift was placed in a large copper kettle filled with paper money. Steve wanted to deposit the growing pile of dollars immediately into the Union Industrial Bank, eager to secure their future. Jolyn, however, still unsure after Michael's experience, suggested leaving the kettle money with Mr. Goldberger. While the music played and the dancers whirled to a Hungarian czardas, the embezzlers back in the Union Industrial Bank were desperately recalculating their losses after the market's continued volatility. Runyon, having rushed back from the exchange floor, likely worried that the bride he met earlier might soon demand her money, revealing the catastrophic hole the thieves had dug in the bank's reserves. But Jolyn and Steve remained blissfully unaware. The teenage bride, focused only on her love, asked her new husband whether, when she became pregnant, "The baby will come out of my belly button." The market's grim reality had not yet touched their new life together. Wall Street and the Edison Memorial. The sound of the nationally advertised and mass-produced alarm clock awoke Edith Stone. She found it amusing to be called by such a splendid device. The clock was the latest model, marking its owner as a social trendsetter. The distant sounds of traffic in Central Park drifted into the bedroom, a reminder that her father, Edward Stone, like most people in the city, had already been at work for several hours. On a hall table, she glanced at her mail, which included an invitation to a dinner party. On Friday morning, October 4th, Edward Henry Harriman Simmons, president of the New York Stock Exchange, stepped briskly out of his home in his top hat. Unaffected by the previous day's headlines announcing the year's worst break to hit the stock market, Simmons maintained his sang-froid, determined nothing would disrupt his plans to marry divorcee Beatrice Vanderpoel Bogart. Only a few close friends were invited, and no mention was made of the stock market. Simmons was particularly pleased he had avoided the press, as he knew reporters would have a field day with the news that the head of the world's busiest exchange was leaving his post for 2 months, especially in this climate. His deputy, Richard Whitney, now acting president, was not invited, but would soon be occupying the president's office, relishing the new powers and secret reports that would soon be at his disposal. The market's mood was volatile. On Wednesday, October 23rd, the market plunged drastically. Adams Express dropped a catastrophic $96 a share, Commercial Solvents $70, and General Electric $35. Despite this, Richard Whitney, attending a horse racing program in New Jersey, declared the market fundamentally sound. Against this backdrop of financial tension, the day of dedication for Henry Ford's American Village in Dearborn was held on Monday, October 21st. From 9:30 a.m., America and the world via radio gawped at a public relations classic in which President Hoover, Will Rogers, Madame Curie, Orville Wright, and Albert Einstein all played carefully timed and designed walk-on parts. The event was staged to celebrate the 50th anniversary of Thomas Edison's incandescent lamp. Journalists, ignoring orders to stay behind barriers, milled around Ford as he guided the luminaries through his recreated historical village, a personal pantheon of American virtue. Security was tight. Ford's chief of personnel, Harry Bennett, deployed armed guards throughout the transplanted historical buildings, including Longfellow's blacksmith's shop and the courthouse where Lincoln practiced law. The reporter sought new angles. Ford obliged by speculating that he might have been King Midas in a previous life. The event was not without market influence. John D. Rockefeller Jr. and Walter Chrysler, both guests, avoided sensitive talk with Ford about the market. Yet even as the dedication proceeded, newsmen were asking Hoover for a reaction to the latest market break. The climax of the day arrived in the evening. Thomas Edison was to reenact the lighting of his incandescent lamp in his original laboratory, transported and reassembled in the village. Graham McNamee of NBC prepared for a worldwide broadcast describing the scene for an estimated 100 million listeners. In New York, John J. Raskob and James Reardon listened to the broadcast by candlelight, as did Joe Kennedy and his family. And Mike Meehan, McNamee's voice was pitched low to match the drama. Mr. Edison has 2 wires in his hand. Now he is reaching up to the old lamp. Now he is making the connection. It lights! Thomas Edison successfully reenacted his triumph, a symbolic victory of light and progress over darkness and doubt, designed by Ford to reassure the nation of its stability and boundless future. However, reality soon intruded on Ford's illusion of tranquility. 30 minutes before the close of trading on that same day, the market, which had declined throughout the afternoon, experienced a late rally. On Wednesday, October 23rd, the day Richard Whitney had abandoned Wall Street for the horse racing track, the market plummeted again, experiencing the year's worst break. As the news spread, Thomas Lamont quickly arranged a meeting of the heads of several major financial institutions at the House of Morgan. The massive selling pressure continued until the close, making the market's behavior the most extreme yet. On the morning of Thursday, October 24th, Frank Montague, vice president of the Union Industrial Bank in Flint, woke before dawn, terrified. He had to face his colleagues in the embezzling ring, knowing the latest market breaks had caught them deep in fraud. Montague's feelings were mirrored across the country. In New York, police wagons arrived in Wall Street, and the area was swarming with anxious crowds, convinced the exchange was about to close. The market opened like a bolt out of hell. General Motors, U.S. Steel, and Kennecott were overwhelmed by sell orders. The panic on the exchange floor was palpable. Men ran, cursed, and tore their shirts. The ticker, despite William Crawford's best efforts, ran 55 minutes late. At 1:30 p.m., Richard Whitney, acting as Morgan's broker, strode onto the floor and, in a clear voice, bid $20 above the last price for U.S. Steel, pumping millions of the bankers' pooled money into the market. This single act of organized support stabilized the market momentarily. When the closing gong sounded, 12,894,650 shares had been traded, a record. The day's losses of $6 billion had been cut in half by the last-minute support. The New York Times reported, "The worst has passed." This delusion sustained the illusion for millions that the crisis was temporary. But the next day, the market would open only slightly better, masking the true extent of the financial rot. Black Thursday, the battle to stop the collapse. 6:30 a.m., Thursday, October 24th. The night before, the day's market break had dominated media reports. Yet early morning radio bulletins quoted Wall Street sources optimistically predicting positive organized support. But in Flint, Vice President Frank Montague, unable to sleep, knew the situation was dire, fearing calamity and finding himself too deep in the quagmire of embezzlement to quit. By 7:30 a.m. on Wall Street, broker Hutton Miller found the crowds outside the brokerage offices were longer than he could ever recall. Those who had battled through the previous day's slump now looked like they couldn't take any more. They were at the end of their resistance. The talk was heavy with rumors. Hoover was going to act. The stock exchange would close. Jack Morgan had pledged millions. A crowd of 5,000 people and more had converged on the financial district, many of them small investors who were overcommitted and anxious for action. Policemen arrived in wagons and fanned out purposefully through the area, blocking traffic and ready for trouble. By 9:30 a.m., Pat Bologna, the shoeblack, observed an expectant hush fall across the crowds, like the silence before the off at a big race. 10 o'clock, William Crawford. The exchange superintendent rang the opening gong. 3 minutes later, a shout swept through W.E. Hutton. "She's trading big and brisk!" The market had opened like a bolt out of hell. For a brief quarter hour, prices remained steady. But at 10:25 a.m., General Motors showed a loss of 80 cents a share. 4 minutes later, Hutt picked up the phone to a hysterical shriek from a caller to "sell at the market." The panic quickly became contagious. On the stock exchange floor, William Crawford saw that all the rules of normal trading were disregarded. Brokers ran, cursed, and pushed. The confusion compounded as the ticker lagged further and further behind, running 55 minutes late. The madness centered at Post 2, where General Oliver Bridgman, the U.S. Steel specialist, was overwhelmed by a roaring throng trying to stop steel's paper value from melting away. At Post 4, a broker yelling orders that made no sense became hysterical and had to be led away. As the market spiraled downward in a wave of liquidation, the dreaded no bid became commonplace. Brokers, desperate to sell, could not find buyers. At 11:30 a.m., Thomas Lamont, the senior partner at J.P. Morgan, sent a message to Charles Mitchell, president of the National City Bank, requesting an urgent meeting to exchange information on the stock market situation. Mitchell quickly agreed to attend. News that the meeting was taking place at all was enough to provide a brief, steadying effect. The public recalled the action of Pierpont Morgan during the 1907 panic and hoped the Morgan magic was still potent. The bankers convened around Lamont's roll-top desk at 23 Wall. Present were Mitchell, Albert Wiggin, William Potter, and Seward Prosser, representing billions of massed banking resources. What they discussed was secret, yet the crowd outside interpreted the arrival of Mitchell in his shirt sleeves as a sure sign things must be bad. At 1:30 p.m., the meeting broke up, and the pool agreed upon was put into action. Richard Whitney, the acting president of the exchange, strode on to the trading floor. Ignoring the stunned Crawford, who prepared to climb the rostrum to announce a closure, Whitney went straight to Post 2. In a loud, clear voice, he demanded the last bid for U.S. Steel. When told $1.95, Whitney immediately raised the bid by 10 full points, shouting, "10,000 at $2.05. Silence fell. followed by a huge cheer that swept across the floor. Smiling broadly, Whitney marched from post to post, placing large buying orders for other key stocks. His confidence was contagious. The selling stopped. Prices instantly steadied. Whitney's dramatic action was organized support in its finest hour. However, the damage was immense. The ticker, running over 2 hours late, finally completed its record at 7:08 p.m. A record 12,894,650 shares had changed hands, yet the initial morning losses of $6 billion had been halved during the afternoon rally. At 3 p.m., Thomas Lamont greeted the press at the Morgan entrance for a rare conference, with one of the most remarkable understatements of all time. He assured reporters, "There has been a little distress selling on the stock exchange, and we have held a meeting of the heads of several financial institutions to discuss the situation." Lamont stated there were no houses in difficulty and declared the situation was due to a technical condition of the market rather than to any fundamental cause. The distress selling was estimated at $6 billion, but the recovery was real, enough to provide comfort. Following the dramatic close, the exchange issued a joint statement from 35 of the largest wire houses. The worst has passed. Charles Mitchell added his assurance, "I am still of the opinion that this reaction has badly overrun itself." The illusion of recovery was briefly sustained, maintaining the facade, confidence and deceit. Thursday, October 24th, ended with a record 12,894,750 shares traded, the worst day in stock exchange history. Yet, as the market closed and the ticker, 248 minutes late, finally completed recording the transactions, an atmosphere of cautious relief settled over Wall Street. The morning's losses of an estimated $6 billion had been halved during the afternoon, thanks in part to the dramatic intervention of the nation's leading bankers. The pivotal moment occurred at midday, when Thomas Lamont, senior partner at J.P. Morgan & Company, gathered several key banking executives at 23 Wall Street. This meeting included Charles Mitchell of the National City Bank, Albert Wiggin of the Chase National Bank, William Potter of the Guarantee Trust Company, and Seward Prosser of the Bankers Trust Company. This illustrious group, representing billions of dollars in banking resources, convened secretly, drawing immediate comparison to the famous meeting of 1907, where J.P. Morgan himself stemmed a panic. Following the conference, Richard Whitney, acting president of the stock exchange and Morgan's official broker, dramatically walked onto the floor. In a clear voice, he bid 10 points above the last sale price for U.S. Steel, spending millions on behalf of the newly formed pool to stabilize the market. This swift action halted the selling frenzy. At 3 o'clock, Lamont met the press outside 23 Wall, a highly unusual event for the fiercely private banking house. Lamont adopted the manner of a man assuring calm in a crisis, stating that the situation was due to a technical condition of the market rather than to any fundamental cause. He minimized the chaos, claiming there had been only a little distress selling and confirming that none of the brokerage houses were in difficulty. The wire houses reinforced this message, issuing a joint statement that the market was fundamentally sound and that the worst has passed. The sense of delusion was profound, extending to the highest levels of government. Only 2 days prior, Lamont had sent a confidential 20-page memorandum to President Hoover, urging the president not to interfere with the market. Lamont's report stated confidently that the normal economic forces were still adequate to correct any imbalances, and that the future appears brilliant. He argued that wide distribution of stock ownership, encouraged by the speculation, was actually solving the problem of social unrest. Charles Mitchell echoed this official optimism. Upon his return from Europe, he had declared on Tuesday, October 22nd, that the market was in a healthy condition. After Thursday's crash, Mitchell doubled down on his public statements, arguing that the reaction had badly overrun itself. On Friday, October 25th, Mitchell's confidence seemed to contribute to the moderate rally, supporting President Hoover's statement that the fundamental business of the country is on a sound and prosperous basis. Yet, behind the mask of assurance, Mitchell was driven by acute personal financial pressure. The shares of his own National City Bank had fallen, threatening to complicate its pending merger with the Corn Exchange Bank. If the price of National City stock dropped below $450, The merger would require the bank to pay out approximately $200 million in cash. Mitchell was forced to turn to J.P. Morgan and Company to borrow $10 million, money he planned to use to buy up his own bank stock and artificially boost its trading price. Simultaneously, Mitchell was preparing a cynical tax evasion maneuver. To offset the millions he had earned in management funds, he planned to sell the National City stock he held, which had plummeted in value, to his wife. This maneuver, by creating a paper loss of nearly $3 million on the stock, pledged as collateral at Morgan's, would eliminate Mitchell's entire tax liability for 1929. Mitchell, like many others, found himself on a moral and financial slippery slope. Despite his public role as a savior of the market, meanwhile, on the West Coast, A.P. Giannini, having rushed to his secret command post in the Mark Hopkins Hotel on Thursday morning, made his own assessment. Although Transamerica stock had held steady, Giannini was deeply worried. He had flown his key lieutenants, Doc and Elisha Walker, back to New York to manage the crisis on the East Coast. Giannini remained fearful that the public's widespread reliance on margin buying would prove fatal when the promised organized buying support eventually ran out. His only comfort on Black Thursday was that he had succeeded in remaining out of sight, avoiding the throngs of panicked investors who gathered outside his bank office, frantic for assurance that their money was safe. By Friday, Giannini saw the market's recovery as fragile, contrasting sharply with the robust confidence projected by the financial leaders in New York. Lamont and Mitchell were ensuring that, for the moment, the delusions of prosperity were sustained, protecting the financial institutions and their own precarious positions from the immediate repercussions of the crash. Giannini knew that the eve of reality was yet to arrive. Black Monday, unrelenting liquidation. Monday. October 28th dawned in a swirl of optimism which enveloped many people in the financial district. Thousands of newcomers' rubbernecks, some with money to invest, converged on the area. Many were drawn by reports that a mountain of buy orders had accumulated in brokers' offices over the weekend. Mike Meehan did not share this enthusiasm. He was nervous. Radio had slumped badly from those halcyon days of 6 months before when it had been over 100. On Thursday it dropped to only 44 but had recovered since then and was now just under 60 at 8:30 a.m. Doc Giannini in New York was taking a rare early call from his brother, A.P. Giannini in San Francisco, where it was 5:30. A.M. Giannini the elder told Doc there was no reason to suppose the market would get more support from the pool if everybody wanted to sell and no one wanted to buy. The banker was already bracing for the possibility of allowing Transamerica stock to find its own level. A somber Doc, like millions of investors and staff in every boardroom in the country, waited tensely for the market to open. William Crawford barely had time to step from his podium before trouble erupted. At Post 2, U.S. Steel opened at $202.25, a full $1.25 off its closing price of Saturday. At Post 17, there was a greater dip as International Tel started $3 down on Saturday's price. The biggest drop of all in these opening moments was at Post 6. General Electric fell $7.50. The ticker started to lag behind. Everywhere the panic of Black Thursday seemed destined to be repeated. By 10:30, steel had crashed. Through the mythical 200 barrier, other blue chips followed in a wave of selling which successively knocked prices down from one low level to another. By 1 p.m., the ticker was 90 minutes late. The news agency tapes were up to the minute. Within seconds of each other, AP and UPI reported that Charles Mitchell had entered 23 Wall. The rumor was born and nurtured that Mitchell was placing his bank's vast reserves behind a new move to stop the rot reminiscent of the day in late March when he had bucked the Federal Reserve and saved the bull market virtually single-handedly. It is almost certain that Mitchell went there to borrow the $12 million he wanted to support his own bank stock. He spent less than 20 minutes inside J.P. Morgan and Company. He walked out, smiling Morgans would loan him $10 million this week. The market steadied when news of Mitchell's smile reached the trading floor. Soon afterward, a broker acting for Morgans began bidding for steel. It quickly rose from $193.50 to $198. The broker was not Whitney, and his effort did not have the effect Whitney's had had on Thursday. Steel soon slipped back to $190. As the afternoon wore on, the selling became even more urgent. In the final hour, nearly 3 million shares changed hands, a figure that in other calmer times would have been good for a day. When Crawford sounded the closing gong, 9212800 shares had been traded. It was less than on Black Thursday, but the fall in prices was far more severe. The Times General average of stocks was down 29 points. This was the largest drop in prices during any day in the entire history of the New York Stock Exchange. All told, securities had fallen in value an estimated $14 billion. The news agency tapes that evening brought a torrent of reports on the unprecedented destruction of wealth. From Boston came the news that Professor Irving Fisher, the market's great bull, had been silenced in the face of the calamitous losses. His arch-rival, the bearish Roger Babson, gloated from his position of safety in Boston that the panic could not be stopped. Jesse Livermore had escaped comparatively lightly. He and his staff began yet another analysis of this latest tremendous break, which had left so many shares so low. The figures were an indication that the snap resilience and ability to make a comeback had been sapped from the market. That was chilling enough. Even more ominous was that most damage had been done in the last few minutes of trading. That was the worst possible omen for the opening next day. Hutton Miller was also counting the cost. He knew that the huge loss was largely concentrated among the small investors who bought on margin. Hundreds of accounts were closed out or wiped clean. These investors were now facing financial ruin. Hutt felt that the organized support was too little too late. He was exhausted and full of foreboding. Frank Montague and his fellow embezzlers in Flint were in despair. They had lost heavily on blue-chip issues and were now $7,000 further in the hole. DeCamp, however, remained outwardly confident, insisting that the losses were temporary and the market was sure to turn up soon, giving them a chance to repay their stolen funds. Montague remained highly distressed and was certain they were trapped. In Washington, President Hoover was being shielded from the true extent of the devastation, but he was aware of the mounting pressure. He and Thomas Lamont had spoken before the close. Lamont repeated his belief that the situation was technically sound and the worst had passed, a message meant to maintain public confidence. But the reality of a 29-point plunge and the frantic efforts needed to stem the tide spoke a different truth. The collapse on Monday, October 28th, proved that the Great Bull market could no longer sustain itself on illusions alone. The attempt to prevent the panic from spreading had failed. Wall Street had moved inexorably toward the edge of the abyss. The market had achieved a record no one wanted, the largest single-day drop in its history. The Great Catastrophe, the day the bubble burst. The devastating market performance on Monday, October 28th, served as the grim prelude to the ultimate catastrophe. The general average of stocks dropped 29 points in the largest single-day decline in the entire history of the New York Stock Exchange, representing an estimated $14 billion loss in securities value. The tremendous pummeling had sapped the market of its resilience, and the severe decline in the final hour of trading on Monday suggested an ominous opening for the morning of Tuesday, October 29th. At the Union Industrial Bank in Flint, Frank Montague woke early to a world shrouded in snow and dread. His financial quagmire, already impossibly deep after a series of disastrous investments, including a massive loss on General Motors stock following Monday's break, demanded a terrible decision. His colleagues, John DeCamp, Ivan Christensen, and Elton Graham, were desperate, having sunk $700,000 in 2 short, terrible weeks. The thieves now believed they must continue to invest, clinging to the delusion that blue-chip stocks would recover. Montague, already sick and close to breaking, chose to plunge further into the mess, unable to face the ruin and disgrace discovery would bring to his loving wife, Louise, and his family. In New York, the atmosphere was thick with gloom and apprehension. Hutton Miller returned to the W.E. Hutton office before dawn, stepping over colleagues who slept fitfully on the floor, knowing the long hours were set to continue. The morning papers offered false hope, predicting recovery through banking support, but Hutt felt the crowds were like the passengers on the Titanic, putting on a brave face as disaster approached. Charles Mitchell, the confident head of National City Bank, had already secured a secret $10 million loan from the House of Morgan the previous day, not to prop up the general market, but to support his own falling bank stock in order to prevent an expensive cash payout for the Corn Exchange merger and cover his vast personal financial exposure. At the New York Stock Exchange, Superintendent William Crawford had worked through the night on the ticker system, ensuring its perfect function. even if it meant omitting necessary quotation digits to keep pace with the expected volume. Mike Meehan, the radio specialist, arrived in his lucky blue suit, projecting an image of cool confidence, though his star stock, radio, had crashed to a mere $48.25 a share, battered by overwhelming sell orders. Precisely at 10 a.m., the market opened like a bolt out of hell. The selling pressure was relentless. Brokers, exhausted and frantic, disregarded all exchange rules, shouting, cursing, and running across the floor. The ticker quickly lagged by 2 hours, plunging investors and brokerage clerks nationwide into blind panic. The personal calamities unfolded rapidly. Edward Stone, the millionaire businessman, had seen his estimated $5 million fortune wiped out on Black Thursday, October 24th. That night, overcome by hysteria and remorse, he had attempted to jump from the 20th floor terrace of his Park Avenue apartment, only to be restrained by his wife, Mabel, and his daughter, Edith. Stone, stripped of his wealth and his pride, had suffered a mental collapse, repeating that, "The money's gone, all of it." His daughter, Edith, realized that the traumatic event had made any lighthearted play about Wall Street impossible. Far out on the Atlantic, aboard the Berengaria, passengers gathered at the floating brokerage office to witness the disaster in real time. The volume of sell orders was overwhelming, turning the stateroom into a scene of pandemonium. Helena Rubinstein, the international beauty mogul, watched her blue-chip stocks tumble. Displaying no outward emotion, she coolly gave the order to sell 50,000 shares of Westinghouse, a transaction executed at $168 a share, resulting in a loss of over $1 million. She accepted the colossal loss without complaint and left the office, leaving behind dazed fellow speculators who had witnessed the ruthless efficacy of the crash. The attempt by Thomas Lamont's pool to stabilize the market failed utterly, unlike Black Thursday when Richard Whitney's bold buying had stemmed the tide. Today, there was no effective, organized support capable of withstanding the deluge of orders to sell at the market. Prices fell vertically, creating a financial vacuum as buyers vanished. By the close of trading, the volume reached a staggering 16,410,030 shares, a record unmatched in Wall Street history. The total value of securities lost that day was estimated in the billions, marking the most disastrous trading day the stock market had ever known. The New York Stock Exchange had collapsed under the weight of panic selling. The age of the bull market, born of illusions of perpetual prosperity and sustained by collective delusion, was over. Conclusion: the aftermath and the reality. The catastrophic trading days leading up to the end of October exposed the fundamental vulnerability of the American financial system, culminating in the complete shattering of the great bull market illusion. On Thursday, October 24th, often recalled as Black Thursday, a record 12,194,650 shares changed hands. This sheer volume, which overwhelmed the mechanical capabilities of the New York Stock Exchange, translated into a stunning $6 billion loss in asset value by midday. Though Thomas Lamont and the gathered titans of finance created a pool to initiate organized buying support, stabilizing the market, and halving the day's losses, this merely offered a temporary delusion of safety. Lamont, emerging from 23 Wall, maintained that the selling was due to a technical condition of the market rather than to any fundamental cause, a statement intended to restore faith. Yet, those reassurances were quickly invalidated by the events of Monday, October 28th. Despite statements from high-ranking officials like Charles Mitchell, president of the National City Bank, who insisted the situation would correct itself if left alone, the market suffered the worst decline in its history up to that point. The selling accelerated in the final hour, concluding a 212,800 share day with a $14 billion loss in value. This acute weakness in the blue chips spread terror through the ranks of stockholders, confirming that the market's snap, resilience, and ability to make a comeback had been entirely sapped. Tuesday, October 29th, marked the culmination of the panic, the day the bubble burst in full. The atmosphere on the trading floor was one of madness and panic, resembling shell-shocked soldiers, as exhausted brokers battled overwhelming sell orders. The trading volume soared, eclipsing all previous records. The human toll was instantaneous, both financial and psychological. In Manhattan, the medical department of the stock exchange quickly became a frontline casualty station, treating cases of exhaustion and disorientation. Edward Stone, a millionaire financier, was among those driven to suicidal despair by the instantaneous wiping out of his $5 million fortune, saved only by the intervention of his family. The disaster exposed the deep moral and structural rot festering beneath the surface of the golden era. The financial community, which had claimed to be stabilizing the market through powerful interventions, was riddled with compromised figures. Charles Mitchell, hailed as a hero for his interventions, was simultaneously planning a dubious $2.8 million tax dodge by selling depreciated bank stock to his wife. Moreover, he was actively trying to borrow millions to prop up his own bank's stock price to force, through a corporate merger, a monumental conflict of interest. The international environment had also been undermined by such instability, notably by the exposure of financier Clarence Hattrey's massive fraud in London, a scandal that served as an early trigger for global investor nervousness. Hattrey's arrest for fraud involving forged scrip certificates underscored the widespread moral laxity that transcended the Atlantic. The small-town American investor, seduced by the notion that everybody ought to be rich and convinced that organized buying support would save them, faced ruin. In Flint, Michigan, the League of Gentlemen, a group of bank officers and tellers led by Christensen and DeCamp, watched their elaborate embezzlement scheme crumble. The sharp breaks of September alone cost them $700,000 in stolen bank funds. By the end of October, their total losses reached catastrophic levels, far exceeding the initial $2.5 million they had misappropriated. Their desperate attempts to recoup losses by leveraging customer deposits on margin collapsed, placing the entire Union Industrial Bank in jeopardy and threatening the savings of thousands of ordinary citizens like the postman Homer Dowdy, who feared his modest savings would be used to cover the thieves' reckless gambles. The crash was more than a financial event. It was, as noted in the author's note, a profound human and family tragedy. The shock of the market's collapse led to lingering doubts. In war, Dad goes off, a hero. But soon after the crash, Dad was always at home. Nagging doubts were raised. Wasn't he smart enough to get a job? Was he really trying to get work? The widespread pain and bitterness were immense, second only to the world wars. Despite the fact that authorities, like Professor Irving Fisher, continued to pronounce that the market decline was merely a shaking out of the lunatic fringe, the reality was that the massive brokers, loans, totaling billions and signaling reliance on unstable credit, had created a situation that could not be corrected without profound suffering. The stock market had, in fact, become the direct precursor to the economic downturn known as the Depression. As the year closed, the world was left to reckon with the aftermath of a speculative fever that proved to be a financial pandemic, the like of which had never before or since been seen.